Good morning, good afternoon, good evening. Now I am going to revise derivative option chapter. Very useful for your exam. So all the basic concept we are going to revise. Please pay full attention. What is a call option? A call option provides the holder the right to buy a specified asset at a specified price on or before a specified date. So it is a right but not the obligation to buy. What is a put option? A put option provides the holder a right to sell specified asset at a specified price on or before a specified date. So a put option is basically bought. It gives you a right to sell but not the obligation to sell. Expectation of various parties in the option market. Now understand what is the expectation of a party who buys a call option, who sells a call option, who buys a put option, and who sells a put option. So that's very important for understanding this option chapter. Long put call means person is buying a call option. When will you buy a call option? When you expect the price to increase. So you're betting on the upside movement. Buyer of a call is expecting price to go up. Long put. Long put means person is buying the put option. What is the expectation of the person buying a put option? They are expecting that price will decrease. So they are betting on the downside movement. Short call means person is selling a call option. And what he is expecting? He is expecting that the price will decrease. So if the price will decrease, the option would lapse and he will enjoy the premium. Short put. Person is selling a put option. They expect price to increase. So what happens if the price will increase? The put option would lapse and premium received becomes their income. Next concept is in the money, out of money, at the money, option for call. So now we are discussing call option. When is a call in the money? A call option is in the money when the market price is more than strike price. When is a call option out of money? When the market price is less than the strike price. And when is a call option at the money? When the market price is equal to strike price. So note that the above position is reverse for the writer of the option. If the buyer of the option is in the money, it means writer is out of money and vice versa. Now let us look at the in the money, at the money and out of money for the put option holder. A put option holder is out of money if the market price is more than the strike price because put will not be exercised. If the market price is less than the strike price, the holder of put option is in the money, and if the market price is equal to strike price, the holder of the put option is at the money. The position will reverse for a writer of the put option. Next, very important, payoff or profit and loss of call option. So this is a general question in the exam. A call option will generate payoff, positive payoff, when the market price is greater than strike price. When the market price is greater than strike price, he will exercise the option. And when he will exercise the option, he will get the difference between the actual market price and strike price. The difference between actual market price and strike price is the payoff. Payoff minus premium paid is the profit or loss. When the market price is below the strike price, the option would lapse and the loss is equal to amount of premium paid. Note, the position of the call seller will just be the opposite of the position of call option buyer. Now we'll see payoff and profit and loss of put option. In case of put option, if the market price is below the strike price, Very important, market price of a share or underlying is below the strike price, then put option is exercised, and when the put option is exercised, the payoff is strike price minus current market price. Strike price minus current market price is payoff. Payoff minus premium is the profit or loss. In case when the market price is greater than or equal to, also you can say, market price is greater than or equal to strike price, put option will lapse, put option will not be exercised, and the loss will be equal to amount of premium paid. Maximum profit and maximum loss in case of call option buyer and call option seller. So if you are a call option buyer, the maximum profit is unlimited. Unlimited means very high. And if you are a call seller, the maximum profit is the amount of premium received. What is the maximum loss of a call buyer? The maximum loss of a call option buyer is the amount of premium paid. What is the maximum loss of a call option writer? Is very high, unlimited, theoretically unlimited, practically very high. Now we'll see the maximum profit and maximum loss in case of put. If you are a put option holder, the maximum profit is equal to strike price minus premium paid. You can quantify strike price minus premium paid. If the share price becomes 0, your payoff will be equal to strike price and minus premium paid. Maximum loss of a put buyer will be premium paid. Maximum profit of a put writer is premium received, and the maximum loss of a put writer is strike price minus premium paid. Next is break even price of a call option. If you buy a call option, it does not mean you start making profit the moment the share price exceeds the exercise price. You have to recover your premium also. So for the put option holder, call option holder, the break even price will be exercise price plus premium. After that, the call option buyer will start making profit. Before this, the call option writer makes profit, and the call option writer starts incurring losses after the break even prices. What is the break even price of put option? The break even price of a put option is exercise price minus premium. That means the share price should fall enough to recover your premium, and thereafter the put buyer starts making profit and put writer starts suffering losses. Position to be taken in the option market. This I think we have discussed quickly once again. If the expected market price is greater than strike price, or if you think market will go up, if you want to take position in call, then buy call. If you want to take position in put, then sell put. This should be put. If the expected price is less than strike price, or if you expect market will go down, then you sell call or you buy put. And if you think expected market price is equal to strike price, market is going to remain same, then no action, because you will not be able to make any profit. Intrinsic value and time value of an option. Very important concept in this chapter. Intrinsic value and time value of an option. Option premium is made up of two components, intrinsic value and time value. Option premium is equal to intrinsic value plus time value. Intrinsic value of an option. First, call option. In case of call option, the intrinsic value is maximum of higher of 0, market price minus exercise price. And in case of put option, the intrinsic value is higher of 0 or exercise price minus current market price. Time value of the option is the balancing figure. Time value of option is option premium minus intrinsic value. Then in your syllabus you have option strategies. How can you create various types of option strategies and benefit from it? So here only I am going to discuss many of these. Option strategies broadly will be divided into three types: combination strategy, spread strategy, synthetic strategy. What is a combination strategy? Here we combine call and put option. We buy call, we buy put, we sell call, we sell put in different combinations, and according to the combination that we choose, the strategies are called straddle, strangle, strip, strap. Straddle, strangle, strip, strap. And here also we have two categories of each of them: long, short, long, short, long, short, long, short. Then we have spread strategy. Spread strategy involves simultaneous option buying and selling, but spread involves only call or only put, not a combination of call and put. And here also we have three types: price or vertical spread, horizontal spread, diagonal spread. And then there is a synthetic strategy where we combine option with stock. So it can be a protective put, put plus share, protective call, call and share. So now we'll briefly discuss these strategies. Straddle strategy can be created in two ways: long, short. If you are creating a long straddle, it means you are buying a call and buying a put, buying a call plus buying a put on the same stock, same expiry date, same strike price, same stock, same expiry date, same strike price. You are buying a call and you are buying a put because you expect that the market will be very volatile. It can go up or it can go down. And then there is a short straddle, opposite of long straddle, where you think market will be non-volatile. You sell a call and you sell a put with the same strike price and same expiry date. If they ask you to calculate the break-even point of straddle, there will be two break-even points: lower break-even point and higher break-even point. Lower break-even point will be strike price minus total premium. Upper break-even point will be strike price plus total premium. If the question is silent, you solve by assuming long straddle. But if you have time in the exam, you solve by short straddle also. Next option strategy is called strangle. Strangle can be of two types: long strangle, short strangle. Sir, how do we create long strangle? A long strangle can be created by buying a call and buying a put on the same stock, same expiry date, but different strike price. And the strike price of put option is lower than the strike price of the call option. The strike price of put option is lower than the strike price of call option. Second way to create a strangle is short strangle. So long strangle is for those who believe that market will be very volatile, then go for this long strangle. But if you think market will be non-volatile, it will be moving in a small price band, then go for short strangle, sell a call, sell a put on the same stock, same expiry date, but different strike price. The strike price of put option will be lower than the strike price of call option. What about the break-even point for strangle position? There will be two break-even points: upper break-even point, which is equal to strike price of long call plus net premium, or you can say higher strike price. There will be two strike price: higher strike price or strike price of call option plus net premium. And in case of lower break even point, you will say strike price for the put option minus net premium, because call will generate profit when the price go up, put will generate profit when the price falls. Another combination strategy is called strip. A strip involves buying one call and buying two puts. Buying one call and buying two puts. Same stock, same exercise price, same expiry date. So why would you enter into a strip strategy? You are expecting that the chances of price decreasing is much more than the chances of price increasing. Here also we can have long strip, short strip. In long strip you buy one call, you buy two puts. In short strip you sell one call and you sell two puts. Then we have strap. The definition printed in the book is for long strap, but the reverse of that becomes short strap. In strap strategy, we are expecting that prices will rise and prices can fall also, but the chance of price rising is very high, and therefore we will buy two call option and buy one put option. Same stock, same exercise price, same expiry date. So this definition is for long strap, and if we sell two call and sell one put, then it becomes short strap. We are expecting in case of long strap the chances of price moving up is very high compared to the price falling. So these were combination strategies: straddle, strangle, strip, strap. Spread strategy. In our syllabus we have to only deal with price or vertical spread. In price or vertical spread, the expiry date is same. The expiry date is same, exercise prices will be different, and we are going to just play with the difference in exercise price, and because difference in exercise price is there is a difference in premium also. So this kind of strategies are for those people who don't want to take high risk, but at the same time there won't be very high profit also. So spread strategy results into low profit and low losses. There are two types of spread strategies we will discuss now, although there are many more, based on two exercise prices and based on three exercise prices. Based on two exercise prices, we can create bull spread or bear spread. When you create bull spread means you are expecting price will go up. When you are creating bear spread, you are expecting price will go down. Now the question will be how to create bull spread. Bull spread can be created in two ways. One, by buying call at a lower exercise price and writing a call at a higher exercise price. Buying a call at lower E and writing a call at higher E. Similarly, how can you create bull put spread? Same, buy a put at a lower exercise price and write a put at a higher exercise price. How can you create bear spread? A bear spread can be created in two ways, by using two calls or by using two puts. So when you are using two calls, it is called bear call spread. Buy a call at higher exercise price and sell a call at a lower exercise price. And bear put spread is created by buying a put at a higher exercise price and selling a put at a lower exercise price. Based on three exercise prices, the spread strategy is known as butterfly spread, that I will cover subsequently. So now dear student, please come to butterfly spread. Butterfly spread can be long butterfly spread or it can be short butterfly spread. Long butterfly spread, how it is created? It involves four options at three different strike prices. Four options at three different strike prices. So how do you create long butterfly spread? buy a call option with a lower strike price, buy another call option with higher strike price, then sell two call option with strike rate in between higher strike price and lower strike price. So this needs some explanations. Suppose there are three exercise prices E1, E2, E3, and you have to create long butterfly. So you will, let us put some number also here, 100, 150, 200. So in case of long butterfly, you will buy one call or maybe put at the lowest exercise price, and you will buy one call at the highest exercise price, and you will write two calls at the middle strike price. So when you are buying at the two extreme exercise prices, it gets a name long butterfly, and when you sell at the two extreme prices, you call it short butterfly. Okay. Next point, all the options should have the same expiry date. All the options should have the same expiry dates. Then next is, what is break even point? Break even point in butterfly spread, there will be two break even points. The break even points will be calculated as follows. Upper break even point will be equal to strike price of the higher strike long call minus net premium paid. So like in the previous example, we have E1, E2, E3, and I had written 100, 150, 200. So this will be equal to 200 minus net premium paid. Suppose net premium paid is 30. So the break even at higher end will be 170, and lower break even price will be equal to strike price of lower strike call plus net premium paid. So what is the lower exercise price? 100, and plus the net premium is 30. So the lower break even price will be, in this example, 130. So this way you can compute the break even price of butterfly spread. Short butterfly spread. Short butterfly spread, what you'll do, sell one call, buy two calls, and sell one call in the same manner as long butterfly spread. Bull call spread, I have told you, buy a call at lower exercise price and sell a call at a higher strike price on the same stock, same expiry date. Break even point for bull call spread, strike price of long call plus net premium paid. Bull put spread strategy, buy put at a lower strike price, sell put at a higher strike price. Bear call spread strategy, buy call at higher exercise price and sell call at a lower exercise price. Then bear put spread, buy a put at higher exercise price and write another put at a lower exercise price. A person creating a bear spread is trying to make profit from a falling market, and if the price falls, he'll make profit, but if the price goes up, he will suffer the loss. Value of call option on expiry date. On the expiry date, the value of call option will be higher of S minus E or 0. Value of put option on expiry date will be higher of E minus S or 0. Next is put call parity theorem. As per put call parity theorem, The relationship between share price, put price, call price and PV of exercise price is as follows. Share price plus put premium must be equal to call premium plus PV of exercise price. And if this equation is not followed, arbitrage opportunity will arise. So the question that you may get in the exam, you may be given call, exercise price, share price, and then they may ask you to find the value of put option. So value of put option will be C plus PV of E minus S. Or sometime what they can do, they can ask you to find out the value of call option given share price, put price and exercise price. So value of call will be S plus P minus PV of E. Next is option valuation models. Now this is the main part of this chapter from where you get questions for 4 to 8 or up to 10 marks in the exam, generally 8 marks. So option valuation models are basically the models which helps us to arrive at the fair value of the option today. So under this we have binomial model, portfolio replicating model, risk neutral model, Black-Scholes model. Binomial model, they will ask you single period, multi-period model. Mostly in the exam they will ask you either European multi-period option or American multi-period option. Portfolio replicating model can be option equivalent approach or stock equivalent approach, and sometimes they ask a more detailed option valuation model, Black-Scholes model. So first I will give you the steps to solve value of an option under binomial model, assuming you have studied this chapter. So binomial model, what you will do, first you calculate delta, difference in option value upon difference in share price. Then step number 2 is find the value of portfolio on expiry date. Then step number 3 will be calculate the present value of portfolio. And then step number 4 will be you will solve this equation and find the value of call. So present value of portfolio equal to delta into share price today minus value of call, and then you will solve this equation and find the value of this call option. So this is binomial model, right? C1, C2 I have told you is the value of call option when share price is S1 or S2. Next is risk neutral model. Why it is called risk neutral model? Investor is assumed to be risk neutral. He is happy with a risk free return irrespective of the risk involved. So step number 1 will be to calculate the probability, where probability can be calculated in 2 ways. One method is to solve this equation. If you are a person good with solving equation, expected return is equal to probability of price increase into percentage increase in price plus 1 minus probability of price decrease into percentage decrease in price, and that should be equated with risk free rate. Then you compute the value of call. Value of call is the PV of expected value of call. Value of call is the PV of expected value of call. And how do you get expected value of call? The expected value of call is based on the probability into option value on expiry. So actually first you should find expected value of the call, and then multiply by the present value factor, you will get the present value of the expected value. Portfolio replicating model. Under portfolio replicating model, case 1 will discuss stock equivalent approach. Why it is called portfolio replicating model? This is one portfolio consisting of stock, one share, and we are going to create another portfolio which will consist of call plus some risk-free asset, and they will generate the same payoff on expiry date. If their future values are same, their present values are also same, and then by solving this equation, you will find the value of call option. So that is why it is called stock equivalent approach. We are replicating the payoff of call and risk-free asset and making it equal to that of the stock. In case of stock equivalent approach, there are two situations possible. Situation 1 is option finishing only in the money. If the option is finishing only in the money, then it means both the prices on expiry date are above the exercise price. Both the prices on expiry date are above the exercise price, and the value of the call option is share price minus PV of exercise price. So S0 is current market price, C0 is the value of call today, and this is PV of exercise price. This formula was derived in the classroom, but right now, because we are just revising, we will not go into the further details. Situation 2 is option finishing out of money. It means one price is above exercise price and one price is below the exercise price. So first you will calculate step 1, PV of lower stock price, not PV of exercise price, PV of lower stock price. Step 2 will be number of calls. Number of call option will be equal to difference in share price upon difference in option value. First you perform these two steps, and after performing these two steps, then you solve this equation. Stock price today is PV of lower stock price, which is as per step 1, plus number of calls bought as per step 2 into C0. And what is missing in this equation which you have to find is the value of call. So that will give you the value of call option today. Now next is option equivalent approach. Why it is called option equivalent approach? So first I'll just briefly explain you that. Here portfolio number 1 is call option, and the payoff of this portfolio will be replicated by buying delta number of shares plus certain amount of borrowing. The payoff of this portfolio is equated with payoff of this. If their future values are same, their present value will also be same. So step number 1 in option equivalent approach is we have to find delta. Same formula, delta is C1 minus C2 upon S1 minus S2. Then we will calculate the present value of borrowing. Present value of borrowing will be equal to N into delta Wait a minute. Present value of borrowing will be equal to, I forgot, how come? I don't know, is n into delta S2 minus C2 upon, either you can write 1 plus R or you can write e to the power RT if you are using continuous compounding. And then you use this present value of borrowing and find the value of call option today, n into delta into S. S is the share price today minus borrowing as per step 2. So this gives you value of call option today. Now we'll come to Black and Scholes model. Under the Black and Scholes model, the value of call option is S into ND1 minus E into e to the power minus RT into N D2, and value of put option is E into e to the power minus RT into N minus D2 minus S into N minus D1. So basically here we have share price minus exercise price, and this ND1 represents the delta and this ND2 represents the probability that the option will be exercised. In case of put option, this N minus D1 represents the delta and N minus D2 represents the probability that the option will be exercised. Okay, and what is the value of D1 and D2? So D1 will be equal to natural log of S by E plus into bracket R plus sigma square by 2 into T upon sigma into under root T. This is how you will calculate D1. ln means natural log. And how will you calculate D2? Don't waste your energy on D2. D1 minus sigma under root T. D1 minus sigma under root T, that will give you the value of D2. What are the notations standing for? C is the price of call, S is the price of underlying asset, E is the price or exercise price, R is risk free rate, T is time until expiration, ND is area under normal curve, LN stands for natural log, and P is the price of the option. Sometimes they ask you theoretical minimum price or lower limit of European call option. So theoretical minimum price or lower limit of European call option is share price minus E into e to the power minus RT, and E into e to the power minus RT is the present value of exercise price. Similarly, theoretical minimum price of put option or lower limit is E into e to the power minus RT minus S, that is PV of exercise price minus share price. So what we have done from the Black and Scholes model, we have removed ND1 and ND2, assuming that the value of ND1 and ND2 are equal to 1. So this is about this revision of derivative options. Thank you very much. All the best. Hello friends. Today we'll take quick summary of interest rate derivatives. So it will just take few minutes and it will revise an important topic, over the counter derivatives. or interest rate derivative. So under this topic you will cover swaps. Under swap you have interest rate swap, currency swap, cross currency swap. Then you can cover swaption in this topic, interest rate future, interest rate option, forward rate agreements. So these are covered under this topic, interest rate derivative. So first we'll discuss hedging of interest rate risk. Interest rate risk can be hedged using various instruments. One of the main instruments which is there in your syllabus is FRA, forward rate agreement. What is a forward rate agreement? It is a contract between parties that determine the rate of interest to be paid or received on an obligation beginning at a future start date. So it is an agreement to borrow or lend a specific amount at a future date. The rate will be negotiated in advance so that in future if the rate goes up, as a borrower you will not suffer the loss, or if the rate falls, as an investor you will not suffer the loss because you have locked the rate well in advance. FRA involves two counterparties. A fixed rate receiver, short, he is called having a short position, and a floating rate receiver, he is said to have long position. Thus being long the FRA, that is fixed pair, means you gain when LIBOR rises. If you have a long position in FRA or if you have bought FRA, it means you are betting on upside movement of the interest rate. So if the interest rate or the benchmark rate goes up, you will stand to gain, but if the benchmark rate falls, you stand to lose. Opposite will happen if you have taken a short position in FRA. A short position means you have sold FRA. It means you are betting on the downward movement of the interest rate. So if the benchmark rate falls, you will gain, otherwise you will suffer the loss. Next issue in FRA is interpretation of FRA. So FRAs are identified in the form of X by Y. How to interpret FRA in the question? Suppose the problem says consider a 3 into 9 FRA at 10% oblique 11%. So how do you pronounce it? This is 3 by 9 FRA. And what are these 10% and 11%? So at 10% you can invest, at 11% you can borrow. These are bid rate and ask rate. It means that interest rate for 6 months. 3 by 9 means after 3 months for a period of 6 months you can borrow or lend. After 3 months for a period of 6 months you can borrow or lend interest. So if you want to borrow, that means if you are bullish, if you are expecting interest rates to rise, so either you can buy or you can borrow the interest at 11% if you expect that the rate will go up. If you are expecting rate will go down, you will take a sell position, that means promise to lend, or short position FRA at 10%. And if the market rate after 3 months goes below 10%, you will get the difference. So 3 into 9 FRA means your obligation or right to borrow or lend after 3 months for a period of 6 months. So if it is written 6 into 12, you have a right and obligation to borrow after 6 months for a period of 6 months. 6 into 9, after 6 months for a period of 3 months. 24 into 27, after 24 months for a period of 3 months. The lower rate means the rate at which you can lend. The higher rate is the rate at which you can borrow. Who will win and who will lose? If you have a long position, if you have bought FRA, you will gain if the rate goes up. Otherwise, you will suffer loss. If you have sold FRA, you have a short position in FRA, you will gain if the interest rate goes down. Otherwise, you will lose. the loser will pay the difference to the winner equal to present value of the difference in interest rate, equal to present value, because the amount will be settled now, whereas the interest should have been paid at the end of the period. So I am not paying at the end of the period, I am paying now. So I will take the present value. Pricing of FRA. How should banks quote FRA rate? The bank should quote FRA rate in such a manner that there is no arbitrage opportunity. Settlement of FRA. FRA are cash settled derivative. Usually cash settled derivative, the winner gets the difference, the loser pays the difference, and the amount paid is equal to the present value of the net difference between interest rate agreed and the reference rate in the contract. So this is the formula for calculating the settlement amount. How do we compute the settlement amount? We will take a notional principal amount. Let us assume 10 lakh. Then reference rate, that is the benchmark rate on which we are betting, LIBOR. Suppose LIBOR after 6 months goes to 12% and the FRA rate is 10%, and it is a problem of 6 months. So we'll take 180. Let us say for simplicity, we'll divide by 360 or 365. And this numerator will give me the difference, 2% of 10 lakh, and it is a 6-month FRA. So 10 lakh into 2% into 6 divided by 12. So that comes to 10,000. So numerator is 10,000. But then that 10,000 is actually payable at the end of 6 months. But settlement is done today. So you will pay or receive present value of 10,000. To calculate the present value, we will take the market rate of interest after 6 months, which is 12% in our example. So I will take 0.12. If it is a 6 monthly problem, this will be divided by 12. So 10,000 divided by 1.06, and the winner will get 9434. The winner will get 9434. This is how FRAs are settled. The differential amount is discounted at post change actual interest rate, as it is settled in the beginning of the period and not at the end. Next is interest rate future. So being a future contract, these are traded on the exchange, and you have to follow all the rules of exchange. There will be a contract size, contract maturity, and like that. So interest rate future is contract between buyer and seller agreeing to the future delivery on any interest bearing asset. Interest rate futures are used to hedge against the risk that interest rate will move in an adverse direction, causing a cost to the company. Interest rate future are similar to forward rate agreement, but interest rate futures are traded on the exchange. Next is interest rate options. So interest rate option means you can take option on interest rate. If you are a borrower, you don't want to pay more than a certain rate, you can buy call option. So when you buy a call option, it is called cap. A cap provides a guarantee that coupon rate each period will not be higher than the agreed limit. So if you are a borrower, then you can fix your upper limit by buying cap, means buying a call option. So if the market rate of interest is more than the cap rate, you will pay at the cap rate. If the market rate of interest is below the strike rate, then you pay at the market rate. How do you compute the payoff of a cap? Again, a highly tested question in the exam. payoff or gross profit of a cap is actual interest rate minus strike rate or floating rate into days to maturity divided by 360. This is for time into nominal loan amount, comma, one more thing I need to write 0. This I'll put in a bracket and then I will write outside the bracket whichever is higher. Because it's an option, you will exercise it when it is favorable. So either it will have a positive value or 0, but not negative. Then we'll come to floor. Suppose you are an investor, you are afraid that interest rate may fall in the coming period, then you may buy a floor, means you will buy a put option. This will guarantee that you will get a minimum rate of interest. So when you buy a floor, that means you buy a put option at a certain strike rate. If the price falls below that strike rate of interest in the market falls below the strike rate, you exercise that put option and you will earn at least that strike rate. But if the market rate of interest goes above the strike rate, you will be more happy. Let the option lapse and you will enjoy the market rate of interest. How to calculate the gross profit of a floor option? Gross profit of a floor is strike rate minus actual rate, exercise price minus market price. It is a put option, into days to maturity divided by 360 into nominal loan amount or 0, whichever is higher. Whichever is higher, because being an option, the answer should not be negative. So I'll put another clause here, or 0, whichever is higher. And then to find net profit, you deduct the premium paid. What is collar? A collar is a combination of cap and floor. A collar is a combination of cap and floor. So by entering into a collar contract, you will fix an upper limit and you also fix a lower limit. So if you are a borrower, you will not pay more than the upper limit and you will not pay less than this lower limit also. So between these two limits, you will pay the interest. If you are an investor, you will get a minimum this much rate of interest. This is the lower limit, minimum you will get, but this is the maximum limit, beyond which you will not earn the interest. So the benefit of collar is it reduces your cost of hedging. You buy call option, you sell put option, or you say you buy cap, sell floor. So premium is paid, premium is received, so net cost of creating a collar is lower. So it is a combination of cap and floor. An interest rate collar sets a maximum and minimum floor boundary on a given floating rate. Another instrument to hedge the interest rate risk is interest rate swap. It's an agreement between two counterparties in which one stream of future interest payment is exchanged for another payment on a specified principal amount. So interest rate swap is a swap of interest obligation or interest receivable. Usually one party pays fixed rate and other party pays floating rate, but sometime there can be floating to floating swap also. So when fixed rate is swapped against floating rate, it is called plain vanilla coupon swap. And when floating to floating is swapped, it is called basis swap. When interest obligations are swapped, it is called liability swap. When interest receivables are swapped, it is called asset swap. So what are the important features of interest rate swap? First, it will effectively translate a floating rate borrowing into fixed rate borrowing and fixed rate into floating. And second important feature is the principal amount is only notional, interest is not received or paid, only the differential amount is received or paid. No exchange of principal. Interest rate swap contract is a separate contract distinct from the underlying loan agreement. Your loan agreement with the bank is not affected. That will continue. One more short-term interest rate swap is called overnight index swap, OIS. It is a short term. It is a very short term. Sometimes the maturity can be 7 days or 10 days. It is a short term interest rate swap involving a fixed rate being exchanged for an index rate like LIBOR or MIBOR or treasury rate. So like interest rate swap, one institution may pay fixed rate and the other institution may pay floating rate. This is for a short period of time. What are the important features of OIS? OIS involves only swapping of interest. Principal is not exchanged, but a notional principal amount is used for calculation of interest. The borrower or the buyer of the contract will pay a fixed rate of interest to the seller and the seller will pay a floating rate to the buyer. The difference between the two amount is settled periodically on a pre-specified date. The difference between two amount is settled periodically on a pre-specified date. When you get a problem in the exam, in case of floating interest calculation, floating interest rate, you must be aware, floating rate interest calculation, it is compounded on daily basis. So they will give you Monday, Tuesday, Wednesday rate, compounded daily, write down, compounded daily, compounded daily. So every day you calculate the interest and add it to the principal amount. And if there is a Sunday, for Sunday, take same rate as Saturday. Take same rate as Saturday. That is a typical exam question without compounding. Without compounding. So Saturday and Sunday can be computed together by taking 2 days. For holidays, take the previous day rate without compounding. Then you compute the interest as per floating rate, interest as per fixed rate. The difference will be received or paid. Another derivative on interest rate is swaption. An interest rate swaption is an option on interest rate swap. That means it is an option to enter into a swap at a later date. It is a right but not the obligation to enter into interest rate swap at a future date, at a particular fixed rate and for a particular term. Example, a 3-month into 5-year swaption. How do you interpret a 3-month into 5-year swaption? It means you have an option to enter into a swap for 5-year interest rate swap after 3 months. So after 3 months you will see what is the fixed rate I have to pay under IRS, under swaption, what is the fixed rate in the market for a similar swap. If you find that the market rate is more, exercise the swaption. If you find that in the market another swap is available at a lower rate, you can let the swaption lapse and you can enter into a new swaption, new swap at the market rate. What are the categories of swaption? Bermudan swaption, European swaption, American swaption. Bermudan swaption are such swaption where the owner can enter into swap on multiple specified dates. So if it is a 3-month swaption, he can enter into swap on certain specified dates only. If it is European option, then he can enter into swaption only on the maturity date. And if it is an American swaption, then he can enter into a swap on any date up to the maturity date. Next is currency swap or parallel loan. In a currency swap or a parallel loan arrangement, two parties agrees to pay each other debt obligation denominated in different currencies. So here we are swapping principal also and interest also. So how does a currency swap works? An American company and a Japanese company, American company need yen, Japanese company need dollar. So they will first exchange principal today. One party will pay dollar, the other party will pay yen based on the spot rate of exchange. And suppose it's a 5-year currency swap arrangement. For 5 years they will pay each other interest, and on maturity the principal amount is again exchanged. Benefits of currency swap: cost cutting, diversification of sources of fund, exchange fluctuation risk is minimized. So this is a quick revision of your interest rate risk management. Thank you. Please join our YouTube channel AS Foundation. We are going to give some more updates on that. Thank you very much. Now we'll take a quick revision of business or corporate valuation chapter. So please open your summary book and formula book. There you will find whatever is appearing on the screen is printed there. You need not write anything. Everything is printed in summary book and formula book. So I will only discuss many important points today. Value of the firm using future maintainable profit method or profit earning capacity value method. So here the value of the business will be future maintainable profit divided by relevant capitalization rate. While calculating future maintainable profit, what we will do, we'll take average past year profit, add the actual expenses and losses which are not likely to occur in future, like loss on sale of fixed asset, loss due to fire, and we will add all profits which are likely to arise in future, like some new contract received, all less all expenses and losses expected to arise in future, that we will deduct, and we will deduct all profits not likely to occur in future. So in the past you have received subsidy, but you may not receive subsidy in future. So this will give you future maintainable profit. This divided by capitalization rate will give you the value of business. Next is value of the firm using discounted cash flow method. That means here we are going to take the present value of the future cash flow. So what are the steps involved in DCF based valuation? First step 1, arrive at the free cash flow. Second step, forecasting of future cash flow, also called projected future cash flow. So we'll have to estimate the future cash flow, estimate the discount rate based on cost of capital. Then fourth step will be to find out the terminal value of the enterprise. Terminal value means value at the end of the explicit forecast period. So we'll divide our forecast into two parts: explicit forecast period, which may be 3, 4 or 5 years, and after that terminal value. Next is finding the present value of both the free cash flow of the explicit forecast period and the present value of terminal value. Add them, that will give you value of the firm. And for value of equity, take the value of the firm minus value of the debt. And for value per share, take the value of equity here and divide by number of equity shares. So this will give you value per equity share under free cash flow to the firm approach. Next concept is enterprise value. Enterprise value is also written as EV, is a measure of company's total value. Enterprise value is a total value and it is a more comprehensive alternative to equity market capitalization. Enterprise value will also include the value of the debt, long-term debt. Second thing about enterprise value can be thought of as the theoretical takeover price if a company were to be bought. So how much amount you'll have to pay to acquire a company. The value of a firm's debt, for example, would need to be paid off by the buyer when taking over a company. Thus, enterprise value provides a much more accurate takeover valuation because it includes debt also in its calculation. So, to keep the story short, enterprise value is value of share plus value of long-term debt, because the buyer who takes over the business will have to also pay the debt. Why doesn't market capitalization properly represent a firm's value? It leaves a lot of important factors out, such as company's debt on one hand and its cash reserves on the other. So how do we compute the enterprise value? That means how much amount one has to pay to take over a company. It is of course market value of equity, which is the major chunk, plus market value of preference share, plus market value of debt, minus minority interest, and minus cash and cash equivalent appearing in the books. Then next is EV multiple. EV multiple can be based on sale or profit. So if it is based on sale, the EV multiple is enterprise value by sale. And if it is based on earning before interest, tax, depreciation, then enterprise value upon earning before interest, tax and depreciation. Free cash flow available to the firm. Free cash flow is advisable under the following situation. In mergers and acquisition, the acquiring firm is not interested in the dividend history of the target firm. When we are acquiring other company, what they have paid in the past is not important. What is important is how much future cash flow this firm will generate. So therefore, future cash flow or free cash flow approach is used when control perspective is there. If the firm does not have the track record of dividend, it is almost impossible to forecast dividend realistically, and in those cases also the free cash flow approach is used. Main thing is for you how to forecast free cash flow to the firm. Take NOPAT, that is net operating profit after tax, add back depreciation because it's a non-cash item, and minus future capital expenditure and minus additional working capital investment. This formula can be written as follows: NOPAT minus, in bracket, capital expenditure minus depreciation plus working capital investment. Capital expenditure minus depreciation plus working capital investment is called net investment. Hence we can say free cash flow to the firm is equal to NOPAT minus net investment. How do you compute NOPAT? When you are using FCFF approach, NOPAT will be equal to EBIT into 1 minus T. Note, since we are calculating the value of the firm, the discount rate used will be WACC. When you are using FCFF approach, discount rate will be overall cost of capital. And how do you compute it? WD into KD plus WE into KE, that is the weighted average cost of capital. Next approach is called free cash flow available to equity shareholder approach, FCFE. So here we are doing the calculation directly for equity shareholder. So FCFE will be equal to PAT minus equity investment. And what is equity investment? Equity investment is that part of net investment which is funded by equity. So we can write this equation as follows. FCFE is equal to PAT minus in bracket 1 minus WD. 1 minus WD means weight of equity into net investment. So you can understand that net investment multiplied by the weight of equity is the equity investment, that part of net investment which is funded by equity. Once again, to revise, net investment is capital expenditure minus depreciation plus change in working capital. There are two possibilities in your question. Debt financing ratio is given, WD is given, then FCFE will be PAT minus in bracket 1 minus WD into net investment. Already covered. Case 2, when WD is not given, if the weight of debt is not given, then take PAT minus net investment plus net borrowing. Net borrowing is equal to borrowing minus repayment. Why net borrowing is added? Net borrowing is added because if a company borrows more in a year than it repays, it will have additional funds that can be distributed to shareholder. So cash flow available to shareholders will go up. Now next is, since in FCFE approach, since we are calculating the value of equity, very important, the discount rate will be the cost of equity and the intrinsic value per share will be here, value of equity divided by number of equity shares. In some exam they ask question on chop shop approach, where we have to find out the important financial ratio of pure play firms. Pure play firms are the firms which are involved only in one line of activity. The technique of identifying firms with publicly traded securities which are engaged solely in the same line of business as the division or the project in question. These comparable firms are called pure play firms. And now the reason for understanding pure play firm is that if you have to value a diversified company which are into different businesses, find out a pure play firm which is comparable to different divisions. Okay, and then you can value each division separately, add them, that becomes the value of a company which is into multi-business activities. So what is chop shop approach? This approach is used for valuing a conglomerate, that is a diversified firm. We will divide the firm into different parts and value each part using price multiple, and finally the value of the firm is the sum total of its parts. This approach attempts to identify multi-industry companies that are undervalued and would have more value if separated from each other. Next is relative valuation method. So relative valuation method refers to how similar firms are valued. So taking the data of similar firms, taking the valuation of similar firm, comparable firms which are similar in nature and scale, we will find the value of a given company. Example, if HUL has a book value per share of 800 and trading price is 2000, its price to book value ratio is 2.5. Then I have another comparable company unlisted, Patanjali. Its book value is 520. So using the comparable company HUL, I will value it at 1300. So there are many types of price multiple used under relative valuation approach. So what you will do, whichever basis you will take, the ratio of comparable company will be calculated as follows. Take the market capitalization or enterprise value divided by value driver. The value driver can be earnings, sales, asset, okay, FCFF, whatever. So we'll discuss few popular price multiples. The most popular is price to earning ratio, but it cannot be used for loss making company. Another popular is price multiple is price to sales ratio. This can be used for even loss making company. Price to book value ratio is also very popular, more specifically in the case of bank and financial institution. Price to FCFE ratio, conceptually it is one of the best method, and price to earning before interest, tax, depreciation and amortization. This can be used for companies which have positive earning before interest, tax, depreciation and amortization, but it has a loss when it comes to PBT. Such companies are usually the companies with heavy interest burden and heavy depreciation burden in the beginning when they are in the expansion phase. For example, the startup companies. Another question which are nowadays tested in the exam is finding the value of a strategy. That is called special case of FCFF approach or ALCAR model. So what will be the question in the exam? They will give you a firm which at present is a no growth firm. It wants to implement a strategy and we will be required to calculate the value of the strategy. The value of the strategy is post-strategy value minus pre-strategy value. The pre-strategy value is simply NOPAT upon K. Post-strategy value will be calculated based on the two statements made under this ALCAR model. Statement number 1 is that the firm's operating margin, that is EBIT, as a percentage of sale will remain constant. It means EBIT as well as NOPAT will grow at the same rate as that of sale. So EBIT and sale will grow at the same rate. Second statement of ALCAR model is all turnover ratio will remain constant. If turnover ratio will remain constant, the growth in capital employed will be same as that of the sale. Here we define net investment as change in capital employed. Types of P ratio. There are two types of P ratio. Trailing P ratio, which is price today upon EPS of the past year or last year. Leading P ratio, it is price today upon EPS of the next year. So if the question gives you trailing P ratio, take last year EPS. If question gives you leading P ratio, take next year EPS. If the problem is silent, write the assumption. Link between P ratio and cost of equity. If there is no growth and 100% dividend payout ratio, then the price of the share will be EPS upon KE, or KE will be equal to EPS upon price. EPS upon price is a reciprocal of P ratio. Therefore, P ratio can be treated as 1 upon KE. So this revision of business valuation is over. All the best. Hello everyone. Now we'll take the quick revision of mergers and acquisition chapter. So we will discuss the formulae that are used in this chapter. So these formulae are printed in your book. You have got one formula book. Keep that formula book open, mergers and acquisition chapter, and all the formulae that I am going to discuss now will also appear in your book. In case if you want to write down anything extra, you are most welcome. First basic formula of this chapter is EPS. What is EPS? EPS means total earning divided by number of equity share. Total earning divided by number of equity shares. And how do you get total earning? It is earning after tax minus preference dividend. Next basic formula is in this chapter P ratio, which is market price upon EPS, or you can also say it is total market capitalization divided by total earning. So I will write one more formula here, or total market capitalization, keep writing whatever you want, divide by total earnings. If this information is given, then you can find out P ratio in this manner. And then the third formula is market price. Market price per share is equal to P ratio into EPS. So we are just playing with the same formula depending upon how the question is asked. Now fourth very important, tick mark, very important formula, calculation of EPS of the combined entity, which we will call post merger EPS. Post merger EPS formula will be EPS of combined company A and B equal to PAT of A plus PAT of B plus synergy value if any, plus synergy value if any. So numerator will be every time PAT of A plus PAT of B plus synergy value if any, divided by total number of shares after merger. Divided by total number of shares after merger. In case of stock deal, stock deal means shares are issued to target company. It will be number of shares of A plus share exchange ratio multiplied by number of shares of B. So that will give me total number of shares after merger. But in case of cash deal, the number of share after merger will be only the number of shares of A. So that much care we should take. Next is, in some exam question they have asked you to find out the net cost of acquisition. Net cost of acquisition would be the consideration paid minus net asset realized immediately on disposal of asset and liabilities. Consideration paid minus net asset realized on disposal of assets and liabilities. So what are the things you will add according to question? First we'll add market value of equity share issued, market value of debenture issued, plus market value of preference share issued, plus payment of current liability, plus payment of unrecorded or contingent liability, and plus any other expenses paid. So these first 6 items you will add, minus sale proceed from sale of asset not required, minus cash in hand and cash at bank received. This may not be mentioned in the adjustment, but if cash and bank is appearing in the balance sheet of the target company, you will deduct it, and the net amount is called net cost of acquisition. There are 3 notes relating to this. Note 1 is current liability must be paid even if the question is silent. Second, sale of asset is to be taken only if the question requires and the asset is not required in the business. Third is cash will be deducted. This is important. because all the questions in the exam are silent about cash and bank in the balance sheet, but cash and bank will be deducted even if the question is silent. First, now come to sixth number formula, EPS of A and B when synergy is expressed in percentage. So they may just say synergy will be 5% after merger. So then the post merger EPS will be earnings after tax of A plus earning after tax of B into bracket 1 plus synergy gain divided by number of shares of A plus number of shares of B multiplied by exchange ratio in case of cash deal. Sorry, share deal. In case of share deal, if it is a cash deal, then you just have to write in the denominator number of shares of A. Next is when the synergy value is expressed in amount. So here the formula will be earnings of A plus earning of B plus synergy gain. Plus synergy gain. So they may say 250 lakh is the earning of A, 50 lakh is the earning of B, synergy gain is 20. So then in that case my total earnings will be 250 plus 50 plus 20 divided by number of shares of A plus number of shares of B into exchange ratio. This formula to be used in case of stock deal, the denominator. In case of cash deal, only write number of shares of A. Next paragraph, formula number 8. Post merger EPS when cash is paid out of borrowed money. This is called leveraged buyout. And in some recent exam, there was question on this leveraged buyout. So what I'll do, I will take earning of A plus earning of B and plus you also mention synergy. These three things will be there minus. Now you see what we will do, when we borrow money and acquire other company, we have to pay interest on that borrowed amount into interest rate, and on that interest amount you get tax shield. So into 1 minus tax rate, borrowed amount into interest rate into 1 minus tax rate. This whole thing we can just call it as interest net of tax. Interest net of tax, because after acquiring the target company we'll have to pay the interest. On interest we'll get tax shield, and more importantly in the denominator just write number of shares of A. Formula number 9 now, EPS of A and B when cash is paid out of business money. When cash is paid out of business money, then in that case there is an opportunity cost involved. So the formula for post merger earning will be EPS of A and B equal to earning of A plus earning of B and plus synergy gain if any, and then minus, you put in bracket cash paid into opportunity cost, because if you pay 100 crore rupees out of your business cash, you have lost the opportunity to earn interest on that into opportunity cost of interest into 1 minus tax rate, net of tax. This 1 minus tax rate is for net of tax. Again important thing, only write number of shares of acquiring. Do not add number of share issued to B, because there is no cash, there is no share issued. Cash is paid. When cash is paid, number of shares will not change. 10th formula, EPS of A and B after 1 year when growth rate is used. So after 1 year, the EPS of A and B will be earning of A plus earning of B into 1 plus growth rate of combined company, and that divided by number of shares of A plus number of shares of B into exchange ratio. So this formula will be used for stock deal. In case of cash deal, do not write this part. And how do you compute the growth rate after merger? If nothing is given in the problem, then post merger growth rate will be weighted average growth rate, that is growth rate of A into earning of A plus earning of A plus earning of B plus growth rate of B into earning of B upon earning of A plus earning of B. This formula is very rarely used in this chapter. Paragraph 11. MPS of A and B in the case of cash takeover. Suppose A acquires B by paying cash. So to the extent you are using business cash, your valuation will fall. So MPS after merger when cash is paid is equal to market value of A plus market value of B plus synergy gain minus cash paid and divide by number of shares of A. Now we'll come to some important formula. Merger value. Standalone value of acquirer plus standalone value of target company and plus synergy value. So post merger value of combined company, post merger value of combined entity will be the standalone value of acquirer plus standalone value of target plus synergy value. Then nowadays they are asking this question, what is the cost in a merger or true cost in a merger? Suppose firm A acquires firm B. The cost in a merger of company A and B, if settled through cash, if it is cash deal, then just check how much cash is paid. Cost to acquiring company, or I can add the word true cost. True cost to acquiring company is value of consideration paid, that is cash paid. How much did you pay? Minus what is the value of the target company, PVB. The difference is called true cost of acquisition to acquiring company. If the merger is financed by the stock, if the merger is financed by shares, that is stock deal, same logic, but here what we have paid to the target company is alpha multiplied by PV of A, AB. So that is the total value of the firm, total value of combined entity. And when I multiplied by the share exchange ratio, what we get is the value of target company in the merged entity. So this is what we can say value of consideration paid. This is what is paid against this value of target company PVB. The value the target company gets in the merged entity minus their standalone value is the true cost of acquisition to the acquirer. So what is alpha? Alpha represents the fraction of combined entity received by the holders of B. So that is their proportionate stake. Ownership position. The word we have used in this chapter, ownership position or percentage holding of the target company. And alpha multiplied by post merger market value of A and B is the value of what firms B shareholders get in firm A. That means the value of target company in the merged entity. Value of target company in the merged entity is called alpha into PVAB. Value of the firm AB will be equal to PV of A plus PV of B plus synergy value. So what you have to do, see, you have to understand the process. First find synergy value, then find value of the combined entity. Then calculate this alpha. This alpha will be the number of shares received by shareholders of B upon total number of shares. Upon total number of shares. When you multiply by total value of the firm, total stake in the merged entity minus their standalone value. And the difference is the true cost of acquisition to A. PV of B means the value of what firm B gives up. NPV of firm A is equal to synergy benefit minus true cost of acquisition. NPV or net gain, you also add this word net gain to the target, to the acquiring company, is the total synergy benefit minus true cost of acquisition. And what is the NPV of firm B? NPV of the firm B is the true cost to firm A. NPV of the target company is the true cost of acquisition to acquiring company. Next point, market value after merger if there is no synergy gain. So if there is no synergy gain, the post merger market capitalization is market capitalization of A and plus market capitalization of B. 15 number of shares after merger. Now sometimes they can give you a reverse question. Earning after tax of A is given plus earning after tax of B is given and possibly synergy gain is also given. Post merger EPS is given. So can I not do the reverse working and find out the number of shares? Yes. Market value after merger. Post merger market price. Very easy. Total market capitalization after merger divided by total number of shares after merger. Next paragraph, share exchange ratio based on EPS. EPS of target company upon EPS of acquiring company. Next, share exchange ratio based on P ratio. P ratio of target company upon P ratio of acquiring company. Share exchange ratio based on market price. Market price of target company upon market price of acquiring company. Share exchange ratio based on book value is book value per share of target firm upon book value per share of acquiring firm. And you add one more thing here. Share exchange ratio based on gross NPA. Suppose in some banking problem this was asked. So now my formula will become gross NPA, GNPA of acquiring company upon gross NPA of, in case of those parameters where lower figure is better, the formula will reverse. So share exchange ratio based on gross NPA is this, or if they say share exchange ratio based on operating cost per share, then I will take the operating cost of acquiring company divided by operating cost of target company. So for those parameters where the minimum value is better, then in that case acquiring company upon target company. 20th number formula, post merger P ratio. So if the question is silent, there are two assumptions possible. One is post merger P ratio will be weighted average P ratio, that is P ratio of A into PAT of A upon PAT of A plus PAT of B. this you put in a bracket to avoid confusion, plus pat of B into pat of B upon pat of A plus pat of B. So profit after tax is being used as weights. Next is post merger MPS is post merger EPS into post merger P ratio. EPS can be found out as MPS upon P ratio. Post merger equity ownership, this you tick important. Equity ownership of target company will be number of shares received, new shares, upon total number of shares after merger. Number of shares received upon total number of shares after merger. An acquiring company's share would be 100% minus the target company's percentage. Either you first compute target company and take acquiring company as a balancing figure, or if you want to compute separately, acquiring company will be number of shares before merger, number of shares of acquiring company before merger, divide by number of shares of acquiring company plus share exchange ratio into number of shares of target company. So this denominator will be same in both the formula. Total market capitalization after merger, total number of shares after merger into MPS after merger, into MPS after merger, or depending upon the question, it can be total earnings after merger into post merger P ratio, into post merger P ratio. If this information is given, this is how you can get the total market capitalization. 25 number, free float market capitalization. Free float market capitalization means market capitalization of the company excluding the market capitalization of the promoters shares. So we will not include promoter share here. We will only include non-promoter share percentage. So the formula is free float market capitalization is equal to total market capitalization into non-promoter holding percentage. One example I'll discuss here. Free float market capitalization is 40%. Total shares 28,75,000. Market price per share is 69.60. So free float market capitalization will be 40% of total market capitalization. 40% of total share into market price. This gives you total market capitalization into 40% will give you free float market capitalization. How to compute swap ratio involving multiple parameters? This you have seen in many problems that swap ratio is based on EPS, book value, MPS, etc. So in that case, first you calculate the swap ratio on the basis of each agreed parameter. So calculate swap ratio on the basis of EPS, MPS, book value or whatever is given. Then they will definitely give you the weights. Multiply by the weights and you will get the weighted average swap ratio. Number of shares to be issued will be the number of shares of target company multiplied by weighted average swap ratio. Two more formulae. Sometime they will ask you a question, what should be share exchange ratio if the EPS of the acquiring company is to be maintained? So in that case, if the question does not have synergy value, then the formula will be EPS of target company upon EPS of acquiring company. So write down the formula. but that is subject to no additional profit. So to save time, you can just take EPS of target company upon EPS of acquirer. If you want that post-merger EPS of the acquirer company should be maintained, and if the question says post-merger MPS of the acquiring company is to be maintained and assuming no synergy benefit, then the share exchange ratio would be MPS of target company upon MPS of acquiring company. Use this two shortcut formula only when there is no synergy gain, right? So this was a very quick revision of mergers and acquisition. Thank you. If you have not yet subscribed to our YouTube channel, then subscribe. Our YouTube channel is AS Foundation. If you have any query, please send your query on WhatsApp number 9766921860, or you can send email also. For any product you want to purchase, you can log into our website www.asfoundation.co.in or our another website www.vino.in. Thank you very much. All the best. Hello friends, today I am going to take the complete revision of foreign exchange management chapter. This will give you a bird's view of your entire forex chapter. We are going to discuss all important concepts and the formulae, and you will also get to know what is the scope of your work for the entire syllabus. So let us begin a quick revision of forex chapter. First we will see domestic currency, also called home currency, and foreign currency. So our understanding starts with identifying domestic currency. A country's own currency is known as home currency or domestic currency. For example, for India, rupee is the domestic currency. Then what is a foreign currency? A currency other than home currency. Currency other than home currency is foreign currency. For example, for India, US dollar will be a foreign currency. Next concept is spot rate and forward rate. What is spot rate? Spot rate is the rate applicable for immediate settlement. And what is forward rate? Forward rate is the rate applicable for future settlement. That is a rate negotiated today, but the settlement will take place at a future date. Now just to remind you, all these formulae and notes are printed in your formula and summary book. So open the formula and summary book and you will find exactly same thing is written there. Go to the forex chapter and you will find them. So don't worry, everything is printed in your formula and summary book. Direct quote. What is a direct quote? Number of units of domestic currency required for 1 unit of the foreign currency. Number of units of domestic currency required for 1 unit of foreign currency. And indirect quote means number of units of foreign currency required for 1 unit of domestic currency. So what is the relationship between direct quote and indirect quote? Direct quote is equal to 1 by indirect quote, and indirect quote is equal to 1 by direct quote. So if for example you are given ₹75 per dollar, it is a direct quote in India. What will be indirect quote for this? So you will just take 1 divided by 75 and the indirect quote equivalent will be 0.0133 dollar per rupees. That is how you convert a direct quote into indirect quote, or an indirect quote into direct quote. Take the reciprocal. Very important, bid rate and ask rate. There are two types of rates in the foreign exchange market. Bid rate, that is, it is the bank's buying rate. Bid rate means the rate at which bank buys foreign currency from the customer. What is ask rate? Ask rate is also called offer rate, bank selling rate. It is the rate at which the bank is selling foreign currency to the customer. Note number 1, the difference between the two represent the profit of the bank. Second note, ask rate will always be greater than the bid rate. Otherwise bank will suffer loss, customer will make profit. Point number 3, the quote of bid rate and ask rate is the quote from the banker's point of view. This is very important. All the rates given in the question to you are from bank's point of view. What is the difference between ask price and bid price known as? It is called spread. Next is swap point or forward margin or forward spot differential. You may be given spot rate, and from the spot rate you have to find out the forward rate by adjusting the swap points. So the difference between forward rate and spot rate is called swap point. Very important question is now how to calculate forward rate using the spot rate. So the swap points can be given to you in ascending order. For example, to make you understand, spot rate may be given 75.20, 75.40, and the swap points may be given as 20.30. This is called ascending order. Then it means the foreign currency is trading at a premium. So forward rate will be, you will have to add 75.40 will become the forward buying rate, and 75.70 will become the forward selling rate. So what you will do, if the swap points are in ascending order, add to get the forward rate. If the swap points are in descending order, like for example spot rate is 75.20, 75.50, swap points are given to you as 20 and 10 swap points. So what will be the forward rate? This is called descending order. The swap point for buying is more than swap point for selling, then you will deduct it. So 75.20 minus 0.20, 75, and 75.50 minus 0.10 is 75.40. So this will be the forward rate when the swap points are in descending order. Banks add margin when they sell to the customer, because a bank also buys from a wholesaler bank, a bigger bank. So therefore margin is adjusted. Margin is the extra amount or percentage charged by the bank over and above the rate quoted by the bank. Margin is charged to recover your transaction cost, commission and profit. So if the bank is buying the foreign exchange from the customer, so what will bank do? Bank will deduct the margin. Bank will deduct the margin. Interbank buying rate minus the exchange margin. Interbank buying rate minus exchange margin. In case the bank is buying foreign exchange from the currency, deduct the exchange margin. If it is given in percentage, then bid rate into 1 minus exchange margin in percentage will give you actual buying rate from the customer. In case bank is selling foreign exchange to the customer, margin will be added. Margin will be added So the exchange rate applicable to the customer will be interbank ask rate into 1 plus exchange margin, or simply put ask rate plus exchange margin. Ask rate plus exchange margin. You can write interbank ask rate plus margin. So bank will make profit on both the transaction. When it buys from the customer, it pays him less than the interbank buying rate. When it sells to the customer, it charges more than the interbank selling rate. One of the most important things in this chapter is finding the cross rate. That is when rate between two currencies are not directly quoted. With the help of other currency pairs, we can find out the rate between two currencies. There are two cross rate rules. Cross rate rule number 1. If the exchange rate between two currencies A and C and C and B, two pairs are given, but we want to find out the rate between A and B, to find the bid rate A per unit of B, we will take bid rate A per unit of C into bid rate C per unit of B. The common currency C gets eliminated and we get the rate for A per unit of B. If you have to find ask rate A per unit of B, you will take ask rate A per unit of C into ask rate C per unit of B. This is cross rate rule number 1. Cross rate rule number 2 is bid rate A per unit of B will be equal to reciprocal of ask rate A B per unit of A. The reason is, if suppose the rate is 50 and 55 for rupees per dollar and you want to find dollar per rupees, so then we will have to take 1 by 55 as bid rate here and 1 by 55 as ask rate, so that the ask rate is always more than the bid rate. And in order to find the ask rate, we have to take reciprocal of bid rate B per unit of A, so that you maintain the consistency. Ask rate is more than bid rate. Forward premium or discount. What is the annualized forward premium or discount? In case of direct quote, if forward rate is more than the spot rate, we will say currency is at a premium. Example, spot rate rupees 50 and forward rate rupees 52, we will say dollar is at a premium and rupee is at a discount. Discount means if the forward rate in the case of direct quote is less than the spot rate, the currency is said to be at a discount. For example, spot rate is 50 and forward rate is 48, it means dollar is at a discount. Calculation of annualized forward premium or discount. A very important formula. They will ask you what is the premium or discount at which dollar is quoted in the Indian forex market. So you will use this formula for direct quote. F minus S divided by S into 12 by N into 100. In case of number of days, then you will take 365 by N. This will give you annualized premium or discount. If the answer is positive, it is premium. If the answer is negative, it is discount. In case of indirect quote, the forward premium or discount is equal to S minus F upon F into 12 by N into 100. Now next is, we will go into international parity relationship. International parity relationship. So three parity relationships we have to study: interest rate parity, purchasing power parity, and international Fisher effect, which is called the relationship between interest rate and inflation rate. What is interest rate parity? It tells you the relationship between interest rate and exchange rate of two currencies. How the exchange rate is affected by interest rate differential in the two countries. Exchange rate of the two countries will be affected by their interest rate differential, which means that exchange rate differential will be equal to interest rate differential between the two countries. The logic is that if a country has higher interest rate, it will attract foreign currency, foreign investment, but that benefit of higher interest rate is nullified by a depreciation in the value of the currency of that country, and therefore you can't make arbitrage profit by borrowing from one country with lower interest rate and investing in country with higher interest rate, because exchange rate will move to nullify the effect of that benefit. The interest rate differential is exactly equal to exchange rate differential, and that is why the arbitrage opportunity cannot arise. So what is the meaning of interest rate differential? It means difference in the interest rate in domestic and difference in the foreign country upon 1 plus RF, rate of interest in foreign country, equal to F minus S by S. So this is the relationship between interest rate and exchange rate. The left side of the equation is called interest rate differential. Rate of interest in domestic country minus rate of interest in foreign country upon 1 plus rate of interest in foreign country, and this is called exchange rate differential, F minus S upon S. The currency in one country with a lower interest rate, as per interest rate parity theorem, if a country has lower interest rate, the currency should be at a forward premium in terms of the currency of the country with the higher interest rate. Therefore, higher interest rate in one country will be offset by the depreciation in the currency of that country. In short, country with low interest rate will find its currency is appreciating. A country with high interest rate will find its currency to be depreciating. What is the equation of interest rate parity? The equation is, if it is a direct quote, 1 plus RD, rate of interest in domestic market, upon 1 plus RF, rate of interest in foreign market, equal to forward rate upon spot rate. This equation we will use when direct quotation is given. In case of indirect quotation, 1 plus RD upon 1 plus RF is equal to S by F when indirect quotation is given. Now in the exam the questions can be, you may have to find forward rate, in some question you have to find domestic rate of interest, in some question you are required to find out the foreign currency interest rate. So using this equation you can find out. If the problem is of 3 months, 6 months, 9 months, 1 month, then the rate of interest will have to be adjusted. For example, if the problem is of 3 months, then RD into 3 by 12 and RF into 3 by 12 we will have to do. If it is a problem of 6 months, then RD into 6 by 12 and RF into 6 by 12. Like that we will have to adjust the rate of interest. Next is arbitrage using notional interest. One of the typical question in the examination is interest rate, is arbitrage possible? They will give you spot rate, forward rate, interest rate in India, interest rate in Europe, and the question is whether arbitrage is possible. One way to check whether arbitrage is possible or not is to calculate the notional interest in home country. Calculate notional interest in home country. Notional interest in home country using IRPT, which means what should the interest rate be in the home country. So first you find out the notional interest rate in the home country by using IRPT equation. So I'll just explain this point. Using this IRPT equation, 1 plus RD upon 1 plus RF is equal to F by S. Take forward rate, spot rate, interest rate in foreign country from the question. Find out this RD as a missing figure. What should be the interest rate so that this equation is satisfied? And then compare with the actual interest rate given in the domestic country. Compare with actual interest rate given in the domestic country. Actual interest rate will always be given in the question. And then there are three possibilities. First possibility is that actual interest rate in domestic country is less than notional interest rate. If the actual interest rate is 10%, notional is 11. If there is a difference, you will say the arbitrage is possible. Money will flow from home country and money will flow to foreign country. So borrow in home country because it is available at a lower rate. Borrow in home country and invest in foreign country. That will be the strategy you will follow because the rate of interest is less than what it should be. Second possibility is that actual interest rate in domestic country is more than notional interest rate. Again there is a difference, arbitrage is possible. This time you borrow in foreign currency and invest in home country. Money will flow to home country because instead of getting 11%, you are actually getting 12%. So it's better to invest if you are getting a higher interest rate. And the third possibility, actual interest rate and notional interest rate both are same. So you will say arbitrage is not possible. You cannot make profit by borrowing in one country and investing in another country. How to take advantage of arbitrage? So once you have identified that there is an arbitrage, a question which they repeat in the exam, show the process of arbitrage. So we will divide our process into 2 steps. 4 steps we have to perform today, 4 steps we will perform on maturity date. Once we are able to identify the country of borrowing and the country of investment from our previous table, borrow from the country from where the money will flow out. Immediately, the moment you find this opportunity, borrow and then convert the borrowed amount into the other currency using the spot rate. So if you borrow in USA, convert into rupees at spot rate. If you are borrowing in rupees, convert into dollar at spot rate. Point 3, invest the amount computed in step number 2. Invest the amount computed in step number 2. So if you have borrowed in USA, invest in India. And also take a forward cover immediately, because this amount which you have invested will need to be reconverted into the currency of the borrowing on maturity. To avoid any exchange risk, take a forward cover. These 4 steps will have to be performed today. And then on maturity, what we will do? Realize the investment of step 3 along with interest. Point 6. Reconvert the amount of step 5 to the currency in step 1 using the forward rate. Forward rate is already logged, so you don't have a risk. You will be able to now convert rupees into dollar or dollar into rupees at the forward rate. Then step number 7 will be repay the amount borrowed in step 1 along with the interest. And then step number 8, here comes your arbitrage gain. The difference between step 6 and step 7, if positive, will give rise to arbitrage gain. So these are the 8 steps you will write in the problem of interest rate parity theorem using arbitrage mechanism. How will you make profit? Next parity relationship is purchasing power parity theorem. It shows the relationship between the price level in two countries and exchange rate, or inflation in two countries and exchange rate. So this theory says exchange rate between the currencies of the two countries equals the ratio between the price of the goods in these countries. The theory also states that exchange rate between the currencies of two countries will adjust to reflect changes in the inflation rate in the two countries. So if the two countries have different inflation, their exchange rate will change, which means inflation rate differential equal to current spot rate and expected spot rate differential. Exchange rate will change to take into consideration the interest rate differential in the two countries in such a manner that inflation rate differential becomes equal to spot rate and expected spot rate differential. Equation of purchasing power parity. Same like interest rate parity, but this time instead of interest rate we will call it inflation rate. 1 plus inflation rate in domestic country upon 1 plus inflation rate in foreign country is equal to expected spot rate upon spot rate if direct quotation is given, or if indirect quotation is given, spot rate upon expected spot rate. This equation you will use when indirect quotation is given. According to PPPT, the currency with higher inflation rate, suppose inflation in India is 10%, USA is 2%, Indian rupee will depreciate, and the country which has lower inflation, its currency would appreciate. If PPPT is not followed, arbitrage opportunities will arise. There are two forms of PPPT. Absolute form. Absolute form says, if suppose example basket of goods cost rupees 1000 in India and the same baskets of goods and service cost $25 in USA, then the exchange rate between the two currencies should be 1000 divided by 25, 40 rupees per dollar. This is called absolute PPP. Okay. Does absolute PPP exist in the real world? The answer is no, because of certain imperfections, like there may be transportation cost, trade barriers, custom duty, duty drawback, government may not allow transportation of certain goods. So therefore practically absolute PPPT may not exactly hold good. What is relative form of PPPT? This we have discussed. If a country has higher inflation than the other country, then this higher inflation is offset by the depreciation in the currency of that country. The third relationship is called international Fisher effect. This shows the relationship between two economic variables, inflation and interest rate. Relationship between inflation and interest rate. So as per international Fisher effect, 1 plus nominal interest rate is equal to 1 plus real interest rate into 1 plus inflation rate. So if a country has higher inflation, the nominal rate of interest would be high. If a country has lower inflation, the nominal interest rate will also be low. So nominal interest rate will adjust for the inflation. Real interest rate will remain same. So what is the relationship between inflation and interest rate? 1 plus rate of interest in domestic country upon 1 plus rate of interest in foreign country is equal to 1 plus expected inflation in domestic country upon 1 plus expected inflation in foreign country. So next discussion is now methods of managing the foreign exchange risk. Very important topic. Several questions in the exams are based on methods of managing foreign currency risk. So first there is a bird's eye view of different methods which we use in our current chapter: forward contract, denomination in local currency, foreign currency account, leads and lags, netting, money market hedge, currency option, currency future, caps and collars. So first discussion we'll take forward contract we have discussed. So we'll discuss now local currency, home currency. This is, you can say, one of the best methods that you can have. You just invoice in home currency and therefore you have shifted the burden of foreign currency movement to the counterparty. But whether you should always go for foreign home currency invoicing or not depends on whether the foreign currency is expected to appreciate. If you are an exporter and if you think foreign currency is going to appreciate, you will make more profit by having foreign currency invoicing. If you are an importer and if you expect that foreign currency is going to depreciate, you will be better off if the invoicing is in foreign currency. So one has to check from the forward market whether foreign currency is going to appreciate or depreciate, and accordingly you may take a decision whether to invoice in home currency or foreign currency. So a small discussion: in case of importer, the decision which of the two alternative will lead to lower outflow of rupee, that currency you will use for invoicing. And if you are an exporter, whether you will use home currency or foreign currency, check which of the two options will lead to higher inflow of rupees. Common sense exercise. Next is forward contract. One of the most important parts of our syllabus is forward contracts. What is a forward contract? A forward contract is a transaction requiring delivery at a future date of a specified amount of one currency for a specified amount of another currency. So basically rate is fixed today, the execution, the delivery, the settlement will take place at a future date. What is the main purpose of forward contracts? The main purpose of the forward contract is to protect the company from the adverse movement of the exchange rate. Then there is a concept called option forward contract. It is quite possible that the exact date of forward contract may not be fixed. The exporter may say, I may receive the payment somewhere between 1st March to 31st March. So here the date of maturity is not fixed. So what the bank will do, bank will take rate on 1st March, rate on 31st March, whichever rate is more beneficial to the bank, that rate will be applied to the customer. That is, the bank will choose that rate which is beneficial for the bank and disadvantageous to the customer. So instead the maturity is left to be decided at the option of the customer. The bank will quote either the beginning rate or end of the option period forward rate, whichever is unfavorable to the customer and favorable to the bank. Gain or loss under foreign exchange market. Another highly tested question is whether the company has benefited by entering into a forward contract. Whether the company has gained or lost by using the forward contract. So let us check how to get that answer. Suppose you are an importer, foreign currency is to be paid. You have entered into a forward contract. Calculate the amount to be paid at forward rate. Compare with the amount you would have paid under spot rate, and the difference will be gain or loss. If the amount paid under spot rate is high and the amount paid under forward rate is less, That means this company has gained by entering into a forward contract. And sometime you have to compare it with the no forward, no hedging. Then compare what is the amount to be paid at expected spot rate. What is the amount to be paid at spot rate? The difference is gain or loss. So this is the gain or loss when no forward cover is taken. Compare it with the gain or loss when forward cover is taken, and then you will be able to comment whether the decision to take the forward cover was right or not. And reverse you will do in case if the foreign currency is to be received. Reverse calculation you will do. You, instead of writing to be paid, you will write to be received. To be received. Compare whether no hedging will give you higher home currency inflow or forward contract will give you higher home currency inflow. So if forward contract gives you higher foreign currency inflow, the decision to take the forward cover is justified. Next highly tested question once again is currency future. So all the attributes of future contract that you have learnt in derivative chapter will be applicable. These are standardized contract. There is a standard maturity date, standard lot size, margin money is required, and all those concepts are still applicable here also. So what is a currency future contract? It's a contract between two parties, let us call them buyer and seller, for the purchase and sale of a particular currency at a specified future date at a predetermined price. The special feature of currency future is that these are traded on the floor of an organized future exchange. That means they are traded through an organized future exchange which is regulated by the laws of the country, and there are some rules and regulations you have to follow if you want to trade on the currency future. Forward contracts are over the counter contract. Currency futures are exchange traded contract. So in case of future contract, the two parties do not interact with each other. This is one Mr. A and this is one Mr. B. So they are not going to interact with each other directly. Rather, they are going to interact with the clearing house of the exchange. So if A has to buy, he will buy from clearing house. If B has to sell, he has to sell to the clearing house. The purpose of having the exchange in between is to ensure that all the contracts will be honored. There is no possibility of default. If they deal with each other directly, in case of loss, the party suffering loss may refuse to honor the contract. But that will not happen in case of currency future. If you are gaining, you will get your gain in your account. So hedging with future has two disadvantages. Hedging with future has two disadvantages. It may not exactly match the transaction exposure in size. Example, you are going to receive a payment of $365,000. Suppose the lot size is 1 lakh dollar. Lot size is $1 lakh. So now in case if you want to enter into future contract, you will have to theoretically enter into 3.65 contracts. But of course 3.65 is not possible. So it will be either 3 or 4. If it is 3 lakh will be hedged, 65,000 will remain unhedged. If it is 4, over hedging, it will become over hedging. And similarly, maturity may not match. You are going to receive the payment on 17 September, but the future contract will mature on say 29 September. So you are going to receive the payment before the maturity date of the future contract. So some degree of risk is still there with future contract. The application of currency future is same as stock future. That means to calculate the gain or loss, we will follow the same principle that we follow in case of stock future. If you have bought future and if the rate goes up, gain, you will get the difference. If the rate goes down, you will have loss. If you have sold future and if the rate goes up, you will lose. If the rate goes down, you will gain. So according to the position that you have taken in the future market, the student will calculate the gain or loss on currency future. If you expect that the exchange rate is going to go up, then buy future. If you expect that exchange rate is going to go down, you sell future and accordingly calculate the gain or loss. Next is currency option. Again here, all the basic fundamentals of currency option remain same, which you have studied in the chapter derivative option, where the underlying was stock or index. Now, what are options? Options are contracts that offer the right but not the obligation to buy or not to buy, or sell or not to sell specified quantity of foreign currency at a specified future date at a specified price. That specified price is called strike price. If the option is not exercised, the option will expire. For this protection, the buyer has to pay a premium to the option writer. What are the types of options in currency option market? Same. There are two types: call option, put option. What is a call option or what is a put option first? A put option gives you a right to sell but not the obligation to sell. So a put option is required when the party has to sell foreign exchange. So normally the exporter will buy put option because the exporter will receive foreign currency. So he wants to ensure that he does not receive less than a certain rate. So he will buy a put option. By buying a put option, you get the right to sell the foreign currency and procure the right amount of domestic currency. And then there is a call option. A call option gives you a right to buy foreign currency at a specified rate, but not the obligation to do so. So therefore, usually importers will buy call option. By buying a call option, they will fix the upper limit, the higher amount they will pay. At the same time, if the rate falls, they will purchase the foreign currency from the market. Remaining calculations like profit, loss, premium, all this will be same as the chapter on derivative stock option. Next is netting and exposure netting. That means when receivable and payables are netted off and only the net amount is received or paid, that is called netting. So what is the netting? It is the process under which debit balances are netted off against credit balances. So if you have to receive from a party, also pay to that party, then why don't you just pay the net amount? That is called netting. There are three types of netting: bilateral netting, multilateral netting, exposure netting. In case of bilateral netting, two parties are involved. Mr. A of India has to pay to Mr. B of USA. Mr. A of India has to receive from Mr. B of USA. So they will just calculate the net amount to be received or paid, and that is only to be received or paid. Multilateral netting means more than two entities are involved. So this will usually be the case of MNCs which have subsidiaries and branches all over the world. So to minimize the loss due to exchange fluctuation and to also save on the spread, that is the difference between ask rate and bid rate, they will instruct their subsidiaries to only settle the net amount. And exposure netting means when you have the same currency as receivable or payable after the same time period. You may not take any forward contract, you will keep the exposure open because you know if the exchange rate appreciates, there is a loss in one part of the transaction, but there is a gain on the other transaction. So loss will be compensated by the gain, and that is called exposure netting. Benefit of netting: by adopting netting process, we not only save our cost but also avoid exchange risk. It reduces the number of intercompany payments and receipts. So it saves lot of difference between spread. It reduces banking cost also because there may be transaction cost involved when you have to transfer funds, and increases central control of the intercompany settlements. Next method of hedging or your foreign currency management is leading and lagging. Leading means advancing. To lead means to advance the timing of payment or receipt, that is receiving early or paying early. Lagging means postponing or delaying the timing of payment or receipt. So one important note: should we always lead or should we always lag? The answer depends on comparing your opportunity cost and the dollar appreciation rate. Accordingly, we'll take the decision. So we have made a small quick summary of whether you should lead or lag. Suppose you are exporter or any party who has to receive the foreign currency at a future date. Check from the forward market whether foreign currency is depreciating or appreciating. If foreign currency is depreciating, always lead. If foreign currency is appreciating, always foreign currency is appreciating, then check whether the investment rate is greater than appreciation rate or investment rate is less than appreciation rate. If the rate of interest at which you can invest money in home country is higher than the rate at which foreign currency is appreciating, it is better to lead the payment and invest in home country. But if the investment rate is less than appreciation rate, lag. If you are an importer, if foreign currency is depreciating, that is F is less than S, always lag. If foreign currency is appreciating, that is F is greater than S, compare your opportunity rate with appreciation rate. If the opportunity rate is greater than appreciation rate, lag. If opportunity rate is less than appreciation rate, lead. And now very important, money market hedging. So what are the steps involved in money market hedging? So I have made a complete summary here. Step number: issue involved, importer's angle and exporter's angle. Importer has a foreign currency liability and exporter has a foreign currency asset. Steps involved: everything is printed in your formula and summary book. First is identify whether you have a foreign currency asset or liability. If you are an importer, you have a foreign currency liability. If you are an exporter, you have a foreign currency asset. Point number 2, create. So what will you create? A matching position needs to be created. So if you are an importer, you have a liability already, create a foreign currency asset. And if you are an exporter, create a foreign currency liability there, so that asset and liability will match on maturity, they will cancel out each other. Point number 3, borrow. Money is required to be borrowed. You are an importer. Importer will borrow domestic currency because he has to invest in USA. So borrow in India for an amount. How much will you borrow? Equal to PV of foreign currency liability. What discount rate you will use? Foreign currency deposit rate. The rate is to be adjusted for the period of deposit. If it's a 3 months problem, an interest rate is given 14%, 14 into 3 by 12. And if you are an exporter, you already have a foreign currency asset, create a foreign currency liability by borrowing an amount which is equal to present value of foreign currency asset discounted at borrowing rate. Rate will be adjusted for the period of loan. Convert. So once you have suppose borrowed in rupees, convert into dollar, or if you have borrowed in dollar, convert into domestic currency at spot rate. Point 5, invest. The amount borrowed will be invested. If you are an importer, you have borrowed in home currency, you will invest in USA. And if you are an exporter, you have borrowed in USA, bring that money into India and invest in the domestic deposit, and then on maturity settle in case the asset and liability. So what you will do in USA, for example, USA is an example, you have a foreign currency liability, but you also have a foreign currency asset in the form of investment. Realize the investment, pay the liability. In case of exporter, he already has a foreign currency asset. Realize the asset, pay the liability. There is no need to bring foreign currency into home currency at a future date. Now the question which normally they ask in the exam is not only a problem of money market hedge, it is also a question involving which of the following hedging technique is more advantageous to the importer or exporter. So if you have to make a choice between forward contract and money market hedge, simply check whether you are an importer or exporter. Let us say you are an importer. Calculate the home currency outflow on maturity under the two alternatives, forward and money market. That alternative which will have lower outflow in home currency will be selected. And suppose you are an exporter, you are going to receive foreign exchange. Compare rupee inflow in home currency on maturity under two alternative. That alternative which gives you higher rupee inflow on maturity will be selected. And one more point, caps and collar. We have learnt about call option. If you are suppose an importer, you will take a call option. This will maximize the upper limit, put a higher limit on the rate of exchange that you will pay. But to buy call option, you have to pay the premium. Premium cost can be too high. So in order to reduce your hedging cost, simultaneously you write a put option also. Writing a put option will bring premium to you, and therefore your hedging cost gets reduced. But by writing a put option, you also fix a lower limit. Buying a call, upper limit, the first, this one, my right hand, and the writing a put puts a lower limit, and the combination of these two is called collar. Combination of the two will be called collar. So when you buy a call option, you put an upper limit. The rate of exchange or the strike rate is called cap rate. But buying call option can be very expensive, so you write a put option which is called floor. And when you combine a call option long position and a put option short position, buying a call and selling a put, together, that is called collar. So it is somewhere between the upper and the lower limit you end up paying. So this is cap. At the top we wear a cap, floor is below, and this is collar between the two. So you end up paying somewhere between the two limits. Next very important topic nowadays is nostro vostro loro account. So let us have a quick summary of nostro vostro loro account. And two types of questions are asked here. One is a theory question, which you will write exactly what is written here, at least equal to this much, or they can ask you to prepare a nostro account and exchange position. So these are the question you get from here. Let us discuss nostro account. It is known in Latin as our account with you. Nostro account means our account with you. First you read the example. Suppose there is a State Bank of India and it has opened a dollar denominated account with Bank of America in New York. So for the State Bank of India, it is a nostro account. So this is an account which is overseas, opened by a domestic bank with a foreign bank or with its own foreign branch of the bank. Second thing is, it is like a current account. The bank will not get any interest on the credit balance. However, if there is a debit balance, it is overdraft, bank will be charged interest. You have to pay interest. All foreign exchange transactions are routed through nostro account. It is prepared the way the passbook is prepared. Actual inflow of foreign currency is credited to this account and actual outflow is debited to this account. So one very important thing is, when you prepare nostro account, only those transactions which will actually result into inflow or outflow of foreign exchange will be recorded. Like for example, forward contracts are not recorded when they are entered into. Demand draft issued is not recorded when it is issued. These transactions are recorded when the amount is realized or paid. Vostro account, just opposite of nostro account. First we'll read the example. Now Bank of America is maintaining an account with State Bank of India. So now for the State Bank of India, it is a vostro account. For Bank of America, it will be a nostro account. So a foreign bank opening a rupee denominated account with an Indian bank. It is an account held by a foreign bank with a local bank. On presentation of draft, the Indian bank would pay to the debit of the foreign bank's account with it. So it is, you can say, just opposite of nostro account. Here the account is maintained by a foreign bank with an Indian bank. Remaining details are same. What is loro account? In Latin it means your account with their bank. Example, State Bank of India account in Bank of America is a loro account for ICICI Bank. So it's a third party account. Third party account. So when State Bank of India and Bank of America are talking to each other and they are referring to ICICI Bank account, then ICICI Bank will become loro account. When ICICI Bank and Bank of America is corresponding and talking about the State Bank of India account, then State Bank of India account is the loro account. It is used when referring to a third party account. Next point is exchange position. Exchange position means the overall position of a bank in a particular currency. It is the net balance of aggregate purchase and sales made by a bank in a particular currency. So in exchange position, we keep a track of what is the total purchase and total sale made in a particular currency. It may be based on actual inflow and outflow. but it may also involve some transaction which may not involve immediate inflow and outflow, which may involve commitment to pay or entitlement to receive. Like in exchange position statement, we will also record forward contract, demand draft issued, bill of exchange discounted, forward contract cancelled, demand draft cancelled, and all such transaction which may not involve immediate cash flow. Some exam tips for you, because this is so easy if you know it, that you will get full 7 or 8 marks in very few minutes, just 2 or 3 minutes. So you can't make mistake in this easy part of this chapter, which does not involve too much of your brainstorming. First exam tip is, most of the question will start with opening balance in Nostro account. Nostro account is like an account you can prepare in a ledger format, debit credit side, or you can prepare in a vertical format, debit column, credit column, and then you will be given opening position in the exchange position, so that will be long or short. If they write overbought position, you will write in purchase or long column. If they write opening position oversold, you will write in sell column or short column. Then second thing, institute will give you a long list of transactions, 8, 10, 15 transactions will be given to you, and you will be required to compute the closing balance in Nostro account and closing position in exchange position. Spot transaction, that means TT purchase and TT sale, TT remittance, they are called spot transaction, immediate transfer of funds, will affect Nostro account as well as exchange position, but forward transaction will only affect exchange position. Bill of exchange discounted today but will be collected later is similar to forward transaction, will not be recorded in Nostro account, will only be recorded in exchange position. If any old forward transaction is settled, then we are going to record in Nostro account, because it was already recorded in the exchange position when the forward contract was entered into. Cancellation of forward contract means a reverse forward contract and will affect only position. So if forward purchase contract is cancelled, you will write in sell column. If a forward sell contract is cancelled, you will write in purchase column. When a draft is made, that means when the demand draft is issued, the dealer or the bank is selling foreign currency. Okay, so you will write in sell column. But suppose the demand draft is cancelled later on, it is like buying back foreign currency, you will write in long or purchase column. DD issued and DD cancelled will not affect Nostro account. If there is a remittance from the Nostro account, the account is obviously debited. In the absence of information to the contrary, if the question only says TT remittance, we will assume it is on account of spot sale, and as you have noted, spot sale will affect both Nostro account and exchange position. If the sales exceed purchases, that means the total of the sale column is more than the total of the purchase column. Okay, to avoid overdraft in the Nostro account, the bank would purchase the requisite foreign exchange in the interbank market and arrange for its credit to the Nostro account. So this is again a typical adjustment in the exam. The examiner will say company wants to keep a balance of $5,000 in the Nostro account. So if the balance is less than 5,000, we will have to purchase USD at spot rate and credit to the Nostro account. But sometimes they don't want to keep also extra amount. So if you have a surplus, you will sell it in the spot market. So if the purchase exceeds sale, the bank is said to be in overbought or long position. And if the sale exceeds purchase, the bank is said to be oversold or short position. In case of exchange position statement, if total of sale column is more than total of purchase, it is called oversold or short position. If the amount of purchase and sale of a particular foreign currency is equal, the position of the bank in that currency is said to be square. So square means zero, net zero balance. Total purchase is equal to total sale. So that was about Nostro, Vostro and Loro account and how to solve exam question, numerical question. Next thing they ask in the exam is arbitrage in foreign exchange market. One question in November 2020 exam was based on arbitrage. So the arbitrage means making riskless profit due to price differential in the two market. No risk, no investment and still making profit because of the price differential in the two market. Then it is called arbitrage, buying and selling of the same commodity in our chapter currency in different market. So question they ask is mostly in London the rate of rupees and pound is so much, in New York the rate of rupees and dollar is so much, in Bombay the rate of this and this currency is so much. Check for arbitrage. So that is geographical or space arbitrage when the same currency is selling at different rates in different foreign exchange market. So you can buy from one market, sell in the other market and you can make profit. So one November 2020 RTP question was based on two currency arbitrage where they have given rate of exchange in Tokyo, rate of exchange in Hong Kong, and then you have to identify whether arbitrage is possible or not. So I will give you a trick to identify arbitrage when two currencies are involved. So step number 1 is express the quotation in the same mode. Express the quotation in the same mode. Suppose in Tokyo the rate is given as 1.50 rupee per yen and in India the rate is given as say 62 yen per rupee. Now you can't compare them directly. So first you bring them into the same mode. First you bring them into the same mode means either bring both of them as rupees per yen or yen per rupees. Both should be in the same mode. This is not same mode. This is rupee per yen, yen per rupee. So I will have to bring them in the same mode so that the comparison can be done. Buy from the bank which has lower ask rate. Buy from the bank which has lower ask rate. So compare the ask rate of the two bank. Compare the ask rate of the two bank. Buy from the bank where ask rate is lower and sell to the bank whose bid rate is higher. Sell to the bank whose bid rate is higher. To make the discussion simple, suppose one bank in India quotes dollar rate 73.30 and 73.50. The other bank quotes 73.60 buying rate and 73.70 selling rate. So buy from the bank which has a lower ask rate. Sell to the bank which has a higher bid rate. Choose the lower of the two selling rate. Choose the higher of the two buying rate. And if the bid rate is higher than the selling rate, then yes, you can make arbitrage. So gain will arise if a bank is willing to buy from the customer at a higher rate than the rate at which other bank is willing to sell to the customer, then arbitrage opportunity will arise. So you as a customer will buy from this bank, the first bank, and sell it to the second bank. This will give rise to arbitrage profit. When three currencies are involved, like Three banks are given. So usually this question comes. Three banks A, B, C. It can be a bank in UK, USA, India, and the rate between three pairs of currencies are given X and Y, Y and Z, X and Z. Then in that case, you will be asked to check for arbitrage. You will be asked to check for arbitrage and then carry out the arbitrage process. Like for example, they will say given 10,000 units of currency X, check for the arbitrage. So what I'll do, I will take any two pair using cross rate. I will try to find out the rate for the third pair. For example, in our case, I will use the rate quoted by bank B and C, and using the cross rate formula, X by Y is equal to X by Z into Z by Y. So this rate I will take from bank C, this rate I will take from bank B. After I get the answer here, suppose I get 70 rupees answer and this bank A is quoting at 72, which means there is an arbitrage opportunity. Or if the bank is quoting say 67, then also there is an arbitrage opportunity. So if the rate quoted by bank, actual rate quoted by bank A is different from the cross rate arrived using the rate of bank B and C, then this will give rise to arbitrage opportunity. So I have written in your notes, don't write, decide where to start from. So first compute any implied cross rate, say X per unit of Y using bank B and C. Compare this with the rate quoted by bank A. If X is overvalued at bank A, sell currency X to bank A. If X is undervalued at bank A, buy currency X from bank A. So what do you mean by undervalued or overvalued? If cross rate is 70, actual rate is 72, so this situation is overvalued. In this case, we should sell currency X to bank A. And if it is 67, for example, this is undervalued, we should buy currency X from bank A. Questions have been completed in your classes on such questions. These are bonus marks in the exam. Now next is international capital budgeting. So first question is a theory question, factors to be considered when investing in foreign currency. So what factors do we consider? Political uncertainty, government can change any time, economic policies in that country, because change in economic policy can affect your outcome, exchange rate, change in exchange rate can make a positive NPV generating project a negative NPV, and there are a lot of tax rules you have to keep in mind like DTAA, transfer pricing, deduction, exemptions. Main thing is now international project appraisal. Okay, two countries are involved, host country, home country. Host country is where the investment is made. Home country is the country which is making the investment. Cash flow will be first generated in the currency of host country. Like India is investing in a project in USA. USA is host country, currency will be dollar in which all cash flows will initially be generated. And then there are two types of approaches to solve a problem of international projects. One is called host country cash flow approach and second is called home currency cash flow approach. Both will give you identical NPV at the end when you complete the problem, but the process is different. In home currency approach, the NPV is arrived in the currency of home country. In foreign currency approach, the NPV is arrived in the currency of host country. So I am going to give you a detailed guideline of how you will approach a question in the exam if the institute specifically asks you for home currency approach. So see, step 1, calculate foreign currency cash flow for each year. Use your normal capital budgeting technique for identifying CFAT in foreign currency. Then compute the forward rate or expected spot rate using IRPT, or you can use purchasing power parity also, which we have discussed few minutes back. So as per IRPT, 1 plus RD upon 1 plus RF is equal to expected spot rate upon spot rate. Take the risk-free rate in domestic country, take the risk-free rate in foreign country and find out the expected spot rate. If it is a 5-year problem, the expected spot rate of first year will become the spot rate for the second year, and then you will have to do this exercise 5 times. Step number 3 will be convert foreign currency cash flow into home currency cash flow. Foreign currency cash flow in step number 1. In step 2, using exchange rate of step 2, convert into home currency and then apply the home currency discount rate. Home currency discount rate is the return required for investing in home currency. Find out the NPV. Your cash flow is converted into home currency. Discount rate is the required return in home currency. You get the NPV. This is called home currency approach. Foreign currency approach, step 1 is same. Compute cash flow in foreign currency. Step 2 is different. Here you have to find out the foreign currency discount rate. The discount rate should be the risk adjusted discount rate. And what is the foreign currency discount rate? It is the risk free rate plus risk premium. While solving international capital budgeting problem, we will assume that risk premium attached to any project will be same in both domestic country and foreign country. Their risk-free rate of interest will be different, and because of that, the required rate of return is different. So there are few formulae to arrive at discount rate. Suppose you have this information. You have been given the risk adjusted discount rate in domestic country. That I will write risky rate, or you can write here risk adjusted discount rate in home country. You have to find out the risk adjusted discount rate in foreign country. So use this equation, 1 plus risk adjusted discount rate in home country upon 1 plus risk adjusted discount rate in foreign country equal to expected spot rate upon spot rate, and this is your missing figure here. So once you solve this equation, this will become the discount rate under foreign currency approach. Or if you are given risk free rate in domestic country, risk free rate in foreign country, risk adjusted discount rate in domestic country, then by solving this equation you can find out the risk adjusted discount rate in foreign country. So if you are using this equation where risk free rate is given in both countries and risk adjusted discount rate is given in domestic country, then using this equation you can find risk adjusted discount rate in foreign country. So this is the missing figure here. And once you get the risk adjusted discount rate, you compute foreign currency NPV. Then after computing foreign currency NPV, you convert into home currency NPV by using the spot rate. Answer under both the approaches will be same, subject to the information given is sufficient in the question. Discount rate will be different because risk-free rate is different. If cash flows are in rupee, discount rate should be rate applicable to investing in rupee. If cash flows are in USD, the discount rate should be rate applicable to investing in USD. Sometimes in some question, they will ask you to calculate withholding tax, because if you are investing in other country, that other country may levy withholding tax. That is, when you are taking the profit out of that country, in addition to the normal tax, they charge one more tax over and above normal tax, and that is called withholding tax. So withholding tax is applicable on surplus amount of profit which is taken by MNC in their own country. Then application of transfer price. When a foreign company produces something in our country, for example, after manufacturing or producing that, they take it back to their own country and sell in their own country. So technically there is no sale in India, and they will not pay tax. But then the Indian government, what they do, they say that you can't use our land only for making product and don't pay tax in India. So on a notional sale value, they will ask you to make some tax payment, and that is called transfer price. Deemed sale value is called transfer price. So that was on international capital management, capital budgeting. Now we'll see international working capital management. So the typical question in the exam here is where we should borrow from, where we should invest. So the answer is also simple. If you have to borrow, then choose that currency where the outflow in home currency on maturity is lowest. And if you have to invest, choose that currency where the inflow in home currency on maturity is highest. So that is simple common sense. Whatever question they will ask you, just see, are we a payer or receiver? If we are a payer, minimize. If you are a receiver, maximize. Sometimes they give the problem of a group. So as a group also, we will see whether all cash flow should be managed by head office. Will that give you more inflow? Or whether the cash flow should be managed by subsidiaries independently, that is decentralized cash management, whether that will give you more inflow on maturity, and that option is chosen. Now the next is execution of forward contract. So what we are going to learn here, in execution of forward contract, we are going to learn the settlement of delivery, cancellation and extension of forward contracts. Normally forward contracts are settled on due date, but there are other possibilities also. The other possibilities are, a forward contract can be delivered earlier than due date, later than due date. A forward contract can be cancelled also, earlier than due date, on due date, later than due date. A forward contract can be extended earlier than due date, on due date and later than due date. So how will you deal with different situations? First, I will take the case of delivery, where the customer wants the delivery of foreign exchange and he has come earlier than the due date. He has come some days or weeks or months before the due date. What will you do? First, you cancel the original contract by entering into a reverse contract, and then settlement of the currency which is delivered before the due date on prevailing spot rate. So what I am going to do, I am going to calculate the agreed rate, interest on outflow or inflow of funds, deliver at the agreed rate, but then we are going to recover some charges from the customer. We are going to check what is inflow and outflow of funds on that day. We'll calculate interest on that day from the date of early delivery to the due date, from the date of early delivery to the due date, and we will also calculate the swap gain or loss if any. If the bank has to enter into a spot purchase and forward sale or spot sale and forward purchase because of early delivery, that is called swap gain or loss. Even if it is gain, it will be passed on to the customer. If it is a loss, recovered from the customer. If there is an interest on outflow, recover from customer. Interest on inflow, pay to the customer. The easiest part of this is this one. If the customer comes on due date, delivery as per agreed rate. If he comes late, that means the FEDI rules allows 15 more days for the customer to come and ask for delivery. Cancel the old contract. Cancel at the spot rate on the rate on the 15th day from the due date, whichever is earlier. If he comes before 15th day, take that rate, otherwise 15th day rate. Interest on outflow of fund will be calculated if any. Swap gain or loss will be calculated if any, and then enter into a new contract to delivery at the spot rate, because he wants delivery, so we will give him spot rate. We will deliver at spot rate when he comes. If he comes on 10th day after the due date, the rate on 10th day will be applicable. The only thing you have to note down here is, if there is any gain, it will not be passed on to the customer. If there is any gain, do not pass to the customer. Do not pass to the customer. Any gain, do not pass to the customer. So swap gain will not be actually passed. Interest on outflow of fund will be charged, but inflow of fund, no interest will be paid. Same thing here also. Cancellation. A forward contract can be cancelled by entering into a reverse contract. The applicable rate, if he comes early, first paragraph is common. If he comes early, then cancel at the forward rate for the balance period and calculate the gain or loss on settlement. The difference between the two rates, the rate at which original contract was entered into and the rate at which the contract is reversed. If it is a gain, customer will enjoy that gain. If it is a loss, recover it from the customer. Suppose the customer comes for cancellation on exactly the due date. It will be cancelled at the spot rate, and the difference, if any, will be either paid to the customer if customer is gaining, or if it is a loss, customer is required to pay for the loss. If suppose the customer doesn't come on the due date, either he comes after due date for cancellation or he comes after 15 days, or he doesn't come, then on the 15th day the contract will be automatically cancelled. He will be charged cancellation charges. If he comes any time between 0 to 15 days after due date, spot rate will be applicable. If it doesn't turn up till 15 day, the rate on 15th day will be applicable for cancellation charges. If any interest on outflow happens, that will be charged. Interest on inflow will not be paid. If there is any swap loss, it will be charged. Swap gain will not be paid. So you can delete this word. In case of late cancellation, if there is a swap gain, don't pay. Swap loss, recover. Then next is extension. Last part is extension. Extension means increasing the due date. Original due date was 30th of June. The customer wants to extend it to 30th of August. This is called extension. So if he comes early, suppose he comes on 1st June only and says I want to extend the contract, cancel the original contract, enter into a new contract for revised maturity. So steps involved will be 3. Cancel the old, cancel at the forward rate for balance period. Because he has come on 1st June, so cancellation will be at 1 month forward rate, and then enter into new forward contract, which in our example it will be a 2 month forward rate, right? And then suppose he comes on the due date only, then the old forward contract will be cancelled at spot rate, new forward contract will be entered into at the relevant forward rate. And if he comes late after the due date, cancel the old contract. So he has to pay 3 charges. Cancellation charges, either you will take the spot rate if he comes before 15 day, or the rate of the 15 day, whichever is earlier. Charge him interest on outflow of fund, if any. Charge him swap loss, if any. Don't pay swap gain, don't pay interest to customer, don't pay cancellation gain to customer. And if he wants to extend the contract, enter into a fresh contract at the new forward rate. Okay, so thank you. This was a very quick revision of your entire forex chapter. I think this was probably a complete summary of your forex chapter. Please subscribe to the YouTube channel, because any amendment, updates, new questions will be now presented in the YouTube channel. And if you like it, go to our YouTube channel, share, subscribe, like, inform your friends also. So this way, a day before the exam, you can just go through this video, keep the formula book in front of you, and this will really help you. Thank you very much. All the best. Okay, now let us quickly revise this bond valuation chapter. तो ये चैप्टर काफ़ी इंपॉर्टेंट है, एक बार इसको हम रिवाइज कर लेते हैं. फर्स्ट हमने क्या देखा था? टाइप्स ऑफ बॉन्ड्स. टाइप्स ऑफ बॉन्ड में है प्योर डिस्काउंट और ज़ीरो कूपन बॉन्ड. इसमें कोई कूपन नहीं है, फेस वैल्यू मैच्योरिटी के दिन रिडीम होगी. दूसरा है कूपन बॉन्ड, ऑल्सो कॉल्ड स्ट्रेट कूपन बॉन्ड. They will pay a stated coupon at periodic interval prior to maturity and pays the bond's face value on maturity. Most of the exam question coupon bond पे होते हैं. अगला है perpetual bond, also called irredeemable bond. इसमें कोई maturity date नहीं होगी and they will pay a stated coupon at periodic intervals. सिर्फ कूपन मिलता जाएगा. फोर्थ टाइप है सेल्फ अमोर्टाइजिंग बॉन्ड. यहाँ पे दे विल पे रेगुलर फिक्स्ड अमाउंट ईच पेमेंट पीरियड ओवर द लाइफ ऑफ द बॉन्ड. तो बॉन्ड का जो प्रिंसिपल अमाउंट होता है वो इंस्टॉलमेंट्स में बॉन्ड की लाइफ के ऊपर पे किया जाता है, और जो आउटस्टैंडिंग अमाउंट रहेगा उस पर कूपन मिलेगा. प्रिंसिपल इज रिपेड ओवर टाइम रैदर देन एट मैच्योरिटी. तीसरा है कॉलेबल बॉन्ड. Callable bond means the bond which can be called back by the company before the maturity. तो कंपनी के पास एक ऑप्शन होता है, अगर वो चाहे तो बॉन्ड को उसकी मेच्योरिटी के पहले कॉल कर सकती है. अगला है पुटेबल बॉन्ड. कॉलेबल बॉन्ड का अपोजिट. यहाँ पे इन्वेस्टर के पास ऑप्शन है कि अगर वो चाहे तो मेच्योरिटी के पहले बॉन्ड को सरेंडर कर सकता है और अमाउंट ले सकता है. जो इस चैप्टर का जो मेन पार्ट है वो है प्रेजेंट वैल्यू ऑफ द बॉन्ड कैलकुलेट करना. प्रेजेंट वैल्यू ऑफ बॉन्ड इज इक्वल टू प्रेजेंट वैल्यू ऑफ ऑल फ्यूचर कैश फ्लोज डिस्काउंटेड एट द रिक्वायर्ड रेट ऑफ रिटर्न. चाहे वो जीरो कूपन बॉन्ड हो, डिप डिस्काउंट बॉन्ड हो, कूपन बॉन्ड हो, परपेचुअल बॉन्ड हो, सेल्फ अमोर्टाइजिंग बॉन्ड हो, सबके लिए फॉर्मूला ध्यान में रखना है प्रेजेंट वैल्यू ऑफ फ्यूचर कैश फ्लोज. अभी अगर ये मान लो कूपन बॉन्ड है तो हम क्या करेंगे, जितने भी कूपन कंपनी पे करने वाली है, ईयरली या हाफ ईयरली या क्वार्टरली, उन सब की प्रेजेंट वैल्यू निकालेंगे और आखिरी साल में कूपन प्लस जो रिडम्पशन वैल्यू होगा उसकी भी प्रेजेंट वैल्यू निकालेंगे यूजिंग योर रिक्वायर्ड रेट ऑफ रिटर्न. दिस प्रेजेंट वैल्यू इज कॉल्ड इंट्रिंसिक वैल्यू ऑफ द बॉन्ड ऑल्सो. ओके. और अगर बॉन्ड सेमी एनुअल कूपन पेइंग बॉन्ड है तो उसमें हम 3 चेंजेस करते हैं. एक तो वो जो कूपन का रेट है उसको आधा कर देंगे, जो आपका डिस्काउंट रेट है, रिक्वायर्ड रेट ऑफ रिटर्न पर एनम है, उसको हाफ कर देंगे, और जो नंबर ऑफ ईयर्स है उसको 2 से मल्टीप्लाई करेंगे तो डबल द पीरियड हो जाएगा. ओके. तो डिवाइड द कूपन रेट बाय 2, डिवाइड डिस्काउंट रेट बाय 2, मल्टीप्लाई नंबर ऑफ ईयर्स बाय 2. परपेचुअल बॉन्ड की प्रेजेंट वैल्यू कैसे निकालते हैं? सबसे इजी फॉर्मूला इस चैप्टर का, इंटरेस्ट अपॉन केडी, कूपन अपॉन रिक्वायर्ड रेट ऑफ रिटर्न. देन वैल्यू ऑफ अ जीरो कूपन बॉन्ड. जीरो कूपन बॉन्ड या डीप डिस्काउंट बॉन्ड के केस में कूपन नहीं होता है, सिर्फ फेस वैल्यू होती है या रिडम्पशन वैल्यू होता है. तो फेस वैल्यू और रिडम्पशन वैल्यू डिवाइड बाय 1 प्लस केडी टू द पावर n. डर्टी प्राइस एंड क्लीन प्राइस ऑफ द बॉन्ड. ये कॉन्सेप्ट तब आता है जब आप बॉन्ड की वैल्यूएशन 2 इंटरेस्ट पेमेंट डेट के बीच में कर रहे हो. सो व्हाट इज डर्टी प्राइस? The dirty price of a bond represents the present value of all future cash flows associated with the bond and also includes interest accrued on its next coupon. इसमें इंटरेस्ट अक्रूड इंक्लूडेड रहता है, इसलिए इसको हम कम इंटरेस्ट प्राइस भी बोलते हैं. और एक है क्लीन प्राइस ऑफ द बॉन्ड. क्लीन प्राइस ऑफ द बॉन्ड मतलब डर्टी प्राइस ऑफ द बॉन्ड माइनस अक्रूड इंटरेस्ट. अगर हम उसमें से अक्रूड इंटरेस्ट निकाल दें डर्टी प्राइस में से तो दैट इज कॉल्ड क्लीन प्राइस ऑफ द बॉन्ड. फॉर्मूला, क्लीन प्राइस इज इक्वल टू डर्टी प्राइस माइनस अक्रूड इंटरेस्ट. रिवर्स वर्किंग करना हो तो डर्टी प्राइस इक्वल टू क्लीन प्राइस प्लस अक्रूड इंटरेस्ट. और अक्रूड इंटरेस्ट कितने महीनों का कैलकुलेट करेंगे? अक्रूड इंटरेस्ट जैसे अकाउंट्स के चैप्टर में भी करते थे, लास्ट इंटरेस्ट पेमेंट डेट से लेकर डेट ऑफ ट्रांजेक्शन तक, तो दैट इज कॉल्ड अक्रूड इंटरेस्ट. और मैं आपको बताता हूं कि आप क्या स्टेप्स फॉलो करोगे ये जब क्वेश्चन आएगा डर्टी प्राइस एंड क्लीन प्राइस ऑफ द बॉन्ड का. तो स्टेप नंबर 1 है फर्स्ट कैलकुलेट द क्लीन प्राइस ऑन द नेक्स्ट कूपन डेट. फर्स्ट कैलकुलेट द क्लीन प्राइस ऑन द नेक्स्ट कूपन डेट. ओके. दैट इज प्रेजेंट वैल्यू ऑफ ऑल रिमेनिंग कूपन प्लस प्रेजेंट वैल्यू ऑफ रिडम्पशन. और उसके बाद हम क्या करते थे, स्टेप 2 विल कैलकुलेट द डर्टी प्राइस ऑन द नेक्स्ट कूपन डेट. हाउ डू यू कंप्यूट? स्टेप 1 लेंगे, उसमें इंटरेस्ट ऐड कर देंगे उस दिन का जो मिलने वाला है, और फिर हम पीछे आएंगे, प्रेजेंट वैल्यू निकालेंगे. अभी हमने स्टेप 2 में डर्टी प्राइस निकाल लिया. स्टेप 3 में कैलकुलेट द प्रेजेंट वैल्यू ऑफ द डर्टी प्राइस ऑन द डेट ऑफ वैल्यूएशन. तो पीछे आ गए. तो अब वैल्यूएशन डेट के दिन मुझे डर्टी प्राइस मिल गया. अब उसमें से हम इंटरेस्ट अक्रूड लेस कर देंगे. कैलकुलेट द क्लीन प्राइस ऑन द डेट ऑफ वैल्यूएशन, तो दैट विल बी डर्टी प्राइस माइनस इंटरेस्ट अक्रूड. सो इस तरह से आप ये जब बीच में कोई वैल्यूएशन करनी हो 2 इंटरेस्ट पेमेंट डेट के दिन तो इस तरह से कर सकते हैं. इस चैप्टर में जो अगला इंपॉर्टेंट पार्ट है वो है टाइप्स ऑफ यील्ड कैलकुलेट करने का. सो बॉन्ड से संबंधित डिफरेंट टाइप्स ऑफ यील्ड कैलकुलेट करने के क्वेश्चन आते हैं, जैसे फॉर एग्जांपल होल्डिंग पीरियड यील्ड, मनी मार्केट यील्ड, बॉन्ड इक्विवेलेंट यील्ड, yield to maturity, realized yield to maturity and current yield. तो पहले हम देखेंगे yield to maturity. What is yield to maturity? The rate of return that an investor expects if the bond is held till maturity. तो बहुत सारे क्वेश्चन में सॉल्व करने के लिए हमें yield to maturity लगता है. So it is the rate of return that investor will expect to earn if the bond is held till maturity. और इसको हम IRR के नाम से भी जानते हैं. दिस रेट इज यूज फॉर डिस्काउंटिंग द एक्सपेक्टेड फ्यूचर कैश फ्लो. अगर आपको क्वेश्चन में पूछा जाए फाइंड द प्राइस ऑफ द बॉन्ड टुडे, तो हम YTM को एज अ डिस्काउंट रेट यूज करेंगे. YTM जो हमने डिबेंचर के चैप्टर में कॉस्ट ऑफ डेट निकालना सीखा था, उसी तरह से हम इस चैप्टर में बॉन्ड का YTM निकालते हैं. तो मैथमेटिकली YTM निकालने के लिए एक इक्वेशन फुलफिल होना चाहिए, आउटफ्लो इज इक्वल टू इनफ्लो, आउटफ्लो इज इक्वल टू इनफ्लो बोथ इन प्रेजेंट वैल्यू टर्म्स। तो जब आप एक इन्वेस्टर हो, बॉन्ड पर परचेस करते हो, तो आपको आज बॉन्ड की प्राइस आउटफ्लो होती है और फ्यूचर में आपको कूपन मिलता है, रिडम्पशन वैल्यू मिलता है। तो आपको एक ऐसा डिस्काउंट रेट फाइंड आउट करना है कि अगर मैं इस डिस्काउंट रेट से फ्यूचर इनफ्लो को डिस्काउंट करूं तो ये मुझे आज बॉन्ड की प्राइस देगा। ठीक है, अगर कूपन बॉन्ड हो तो वाईटीएम हम एक फॉर्मूले से निकाल सकते हैं। ये फॉर्मूला क्या है? C प्लस प्रो रेटेड डिस्काउंट अपॉन M प्लस P बाई 2, या फिर कूपन प्लस डिफरेंस बिटवीन मैच्योरिटी वैल्यू माइनस द प्राइस ऑफ द बॉन्ड टुडे डिवाइड बाई नंबर ऑफ ईयर्स अपॉन एवरेज ऑफ मैच्योरिटी वैल्यू यानी रिडम्पशन वैल्यू प्लस प्राइस ऑफ द बॉन्ड टुडे। ये फॉर्मूला तभी यूज करना जब कूपन बॉन्ड हो, या फिर आईआरआर का फॉर्मूला यूज कर सकते हैं। नेक्स्ट है यील्ड टू कॉल। तो कॉलेबल बॉन्ड अभी आपने देखा, वाईटीएम ऑफ अ कॉलेबल बॉन्ड, वाईटीएम ऑफ अ कॉलेबल बॉन्ड इज कॉल्ड यील्ड टू कॉल, और उसकी कैलकुलेशन भी वैसे ही करनी है जैसे कूपन बॉन्ड की थी आपने। यहां पर आप कूपन लेंगे प्लस कॉल वैल्यू, जिस अमाउंट पे वो कॉल होगा, माइनस इशू प्राइस अपॉन कॉल ईयर्स अपॉन कॉल वैल्यू प्लस इशू वैल्यू बाई 2। सेम फॉर्मूला है। और जहां पर ये कूपन बॉन्ड नहीं होगा वहां पर आप आरआर का फॉर्मूला यूज करके सॉल्व कर सकते हैं वाईटीएम। अब देखते हैं रिलेशनशिप बिटवीन वाईटीएम एंड कूपन रेट। वाईटीएम और कूपन रेट के बीच क्या रिलेशनशिप है? अगर कूपन रेट इज इक्वल टू वाईटीएम, द बॉन्ड इज ट्रेडिंग एट पार, इट इज अ पार वैल्यू बॉन्ड। अगर कूपन रेट ज्यादा है और वाईटीएम कम है तो इसका मतलब इट इज अ प्रीमियम बॉन्ड, द बॉन्ड इज ट्रेडिंग अबव द पार वैल्यू। और अगर कूपन रेट कम है और वाईटीएम ज्यादा है तो इसको हम बोलेंगे डिस्काउंट बॉन्ड, दैट मीन्स द बॉन्ड इज ट्रेडिंग एट अ डिस्काउंट, द बॉन्ड इज ट्रेडिंग बिलो पार। नाउ नेक्स्ट इज करंट यील्ड। करंट यील्ड का फॉर्मूला है एनुअल इंटरेस्ट अपॉन करंट प्राइस ऑफ द बॉन्ड। इससे हमें क्या पता चलता है कि आज अगर हम इस प्राइस पे बॉन्ड खरीदते हैं और जो इस साल हमें इंटरेस्ट मिलने वाला है तो हमारा रिटर्न क्या होगा। बट इट इज नॉट द इंट्रिंसिक वैल्यू, क्योंकि हम इसमें सिर्फ एक साल का कूपन ले रहे हैं, हम भविष्य के कूपन और रिडम्पशन वैल्यू को कंसिडर नहीं कर रहे हैं। अगला जो यील्ड है वह होल्डिंग पीरियड यील्ड। होल्डिंग पीरियड यील्ड कैसे निकालते हैं? जब आप कोई बॉन्ड को खरीदते हो, एक अमाउंट पे खरीदते हो जिसको हम बोलेंगे इनिशियल इन्वेस्टमेंट, और उस बॉन्ड से आपको दो प्रकार की कमाई होती है, एक होता है कूपन और एक होता है कैपिटल गेन। हालांकि ये कैपिटल गेन की जगह कैपिटल लॉस भी हो सकता है। सो कूपन प्लस कैपिटल गेन अपॉन इनिशियल इन्वेस्टमेंट। और अगर आप इसको फॉर्मूले के रूप में लिखना चाहते हैं तो C प्लस कूपन प्लस P1 माइनस P0 अपॉन P0, यानी जिस पीरियड के लिए आप बॉन्ड को होल्ड कर रहे थे आपको क्या रिटर्न मिला। अगर उसको एनुअलाइज करना हो तो हम इंटू 12/n वगैरह कर सकते हैं। ठीक है, उसके बाद है मनी मार्केट यील्ड। मनी मार्केट यील्ड कैसे निकालेंगे? पहले आप होल्डिंग पीरियड यील्ड निकाल लो। सपोज हमने 3 महीने का रिटर्न निकाला 3%, तो साल का कितना हुआ? इंटू 12/n व्हेन मंथ्स आर गिवन, इंटू 365/n व्हेन डेज आर गिवन। तो होल्डिंग पीरियड यील्ड को हम एनुअलाइज निकाल कर सकते हैं एंड दैट इज कॉल्ड मनी मार्केट यील्ड। अब एक होता है एक्सपेक्टेड एनुअल यील्ड, EAY। एक्सपेक्टेड एनुअल यील्ड कैसे निकालेंगे? 1 प्लस होल्डिंग पीरियड यील्ड, 1 प्लस होल्डिंग पीरियड यील्ड टू द पावर 12/n, टू द पावर 12/n माइनस 1। यानी 1 रुपया को अगर मैं बार बार इन्वेस्ट करूं तो 1 साल के बाद कितना अमाउंट मिलेगा, दैट इज होल्डिंग, दैट इज इफेक्टिव एनुअल यील्ड। और एक क्वेश्चन आता है एग्जाम में, बॉन्ड इक्विवेलेंट यील्ड। सो कैलकुलेट द यील्ड फॉर 6 मंथ्स। जैसे अभी हमने इक्विवेलेंट एनुअलाइज यील्ड में 1 साल का यील्ड निकाला, बॉन्ड इक्विवेलेंट यील्ड में पहले आप 6 महीने का यील्ड निकालोगे एंड देन मल्टीप्लाई बाय 2 एंड इट इज कॉल्ड बॉन्ड इक्विवेलेंट यील्ड। तो बहुत सारे सेमी एनुअल कूपन बॉन्ड में हम पहले 6 महीने का रिटर्न निकाल लेते हैं और इंटू 2 कर देते हैं, दैट इज कॉल्ड बॉन्ड इक्विवेलेंट यील्ड कंपाउंडेड 6 मंथली। फॉर्मूला वाइज 1 प्लस होल्डिंग पीरियड यील्ड टू द पावर 6/n, तो 6 महीने का यील्ड आ गया -1 रेट ऑफ रिटर्न आ गया 6 महीने के लिए इंटू 2, तो दैट विल गिव यू एनुअल यील्ड विच इज कॉल्ड बॉन्ड इक्विवेलेंट यील्ड। और एक क्वेश्चन जो एग्जाम में कभी कभी आता है, रियलाइज यील्ड टू मैच्योरिटी। तो रियलाइज यील्ड टू मैच्योरिटी में हम क्या करते हैं कि जो भी कैश फ्लो बॉन्ड जनरेट कर रहा है उसको मैच्योरिटी के दिन पहले हम लेकर जाते हैं यूजिंग एन अप्रोप्रिएट इन्वेस्टमेंट रेट, अप्रोप्रिएट इंटरेस्ट रेट। तो कैश कूपन को लास्ट ईयर तक लेकर जाओ, तो और लास्ट ईयर में जितने कैश फ्लो अभी आपके अक्यूमुलेट हो गए उसको जोड़ दो, उसको हम बोलेंगे टर्मिनल वैल्यू इन द लास्ट ईयर। और उसके बाद आपको एक डिस्काउंट रेट फाइंड आउट करना है, ऐसा डिस्काउंट रेट फाइंड आउट करना है जिससे वो जो टर्मिनल ईयर में वैल्यू आपने कैलकुलेट किया उसका प्रेजेंट वैल्यू आज बॉन्ड के प्राइस जितना होना चाहिए। सो दैट डिस्काउंट रेट विच विल इक्वेट द टर्मिनल वैल्यू with the price of the bond today, that return or that yield is called realized yield to maturity। इस चैप्टर में एक और कैलकुलेशन जो बहुत पॉपुलर है, बहुत एग्जाम ओरिएंटेड है, वो है ड्यूरेशन ऑफ द बॉन्ड। ड्यूरेशन ऑफ द बॉन्ड इज द वेटेड एवरेज लाइफ ऑफ द बॉन्ड विच कंसिडर द साइज एंड टाइमिंग ऑफ ईच कैश फ्लो। तो अगर आपको याद हो रहा होगा, हमने कई बार ऐसा किया, समेशन present value into year upon summation present value and that gives you the duration। तो duration मतलब average maturity। यहाँ पे ये जो present value है it is acting like weight, okay, it is acting like weight। तो हम क्या करते हैं, weighted average calculation में हमेशा जो नंबर होता है उसको उसकी weight से मल्टीप्लाई करते हैं और total of the weight से डिवाइड कर देते हैं, दैट इज कॉल्ड ड्यूरेशन ऑफ द बॉन्ड। तो वापस नीचे वही लिखा हुआ है, द वेट असाइंड टू ईच पीरियड इज द प्रेजेंट वैल्यू ऑफ द कैश फ्लो एट दैट टाइम एज अ प्रोपोर्शन ऑफ द प्राइस ऑफ द बॉन्ड। तो ड्यूरेशन के लिए आप ये फॉर्मूला जब भी आंसर लिखोगे लिखना, ठीक है। ड्यूरेशन इज द एवरेज टाइम टेकन बाय एन इन्वेस्टर टू कलेक्ट हिज और हर इन्वेस्टमेंट। तो यहाँ पे उसी चीज को फॉर्मूले के रूप में लिखा हुआ है। इस फॉर्मूले को इतना याद रखने से अच्छा है कि आप बस इतना ध्यान रखना, ड्यूरेशन इज इक्वल टू समेशन ऑफ प्रेजेंट वैल्यू इनटू ईयर अपॉन समेशन ऑफ प्रेजेंट वैल्यू, वही लिखी हुई है बात। अब आता है एक दूसरा फॉर्मूला ड्यूरेशन का, एक और अल्टरनेटिव फॉर्मूला भी है मेरे पास, करंट यील्ड अपॉन वाईटीएम इनटू पीवी एन्युटी फैक्टर वाईटीएम कॉमा एन इंटू 1 प्लस वाईटीएम प्लस 1 माइनस करंट यील्ड अपॉन वाईटीएम इंटू एन। ये फॉर्मूला यूज कर लेना, इससे भी आंसर आ जाएगा, लेकिन पहले उसके लिए आपको करंट यील्ड और वाईटीएम दो फिगर कैलकुलेट करके रेडी रखना होगा। फिर है ड्यूरेशन इज इक्वल टू, इसी चीज को हम इस तरह से भी लिख सकते हैं, यील्ड रेशियो, सी वाई अपॉन वाईटीएम को बोलेंगे यील्ड रेशियो, इसको बोलेंगे एन्युटी फैक्टर, इसको बोलेंगे वाईटीएम फैक्टर प्लस 1 माइनस यील्ड रेशियो इनटू नंबर ऑफ ईयर्स। लेकिन अगर बॉन्ड पार पे ट्रेड हो रहा है, तो आपने पढ़ा है कि अगर बॉन्ड पार पे ट्रेड हो रहा है तो करंट यील्ड इज इक्वल टू वाईटीएम इक्वल टू कूपन रेशियो, तो ड्यूरेशन विल बिकम इक्वल टू एन्युटी फैक्टर इनटू वाईटीएम फैक्टर, एन्युटी फैक्टर इनटू वाईटीएम फैक्टर। अब आप देखो ये एन्युटी फैक्टर इनटू वाईटीएम फैक्टर क्या है, एक बार मैं इसको एक्सप्लेन कर दूं, वैसे आज एक्सप्लेनेशन का काम नहीं। ये फिगर 1 हो जाएगा और ये भी 1 हो जाएगा अगर करंट यील्ड और वाईटीएम एक बराबर है, तो ये पोर्शन 0 हो जाता है, ये 1 हो गया, तो बचा क्या, बचा ये सिर्फ जो अब मैं लाइन कर रहा हूँ, पीवी एन्युटी फैक्टर इनटू ब्रैकेट वाईटीएम कॉमा एन इंटू 1 प्लस वाईटीएम। लेकिन ये शॉर्टकट कब यूज करोगे बच्चों, ये शॉर्टकट तभी यूज करना व्हेन द बॉन्ड इज ट्रेडिंग एट पार, और इससे आपका बहुत टाइम बच जाता है ड्यूरेशन कैलकुलेट करने का। कुछ क्वेश्चन में ऐसे आए हैं जहाँ पे ड्यूरेशन ऑफ अ पार बॉन्ड का वैल्यू निकालने दिया गया है। अभी नेक्स्ट इज कुछ ड्यूरेशन से रिलेटेड कुछ बातें सीख लो और काम आएगा। ड्यूरेशन ऑफ अ जीरो कूपन बॉन्ड कितना होता है? इक्वल टू मैच्योरिटी ऑफ द बॉन्ड। नेक्स्ट कैलकुलेशन है मॉडिफाइड ड्यूरेशन। मॉडिफाइड ड्यूरेशन इज ड्यूरेशन अपॉन 1 प्लस YTM। मॉडिफाइड ड्यूरेशन का पर्पस क्या है? 1% चेंज इन YTM will lead to modified duration percent change in bond price in opposite direction approximately क्यों? क्योंकि मॉडिफाइड ड्यूरेशन लीनियर रिलेशनशिप अज्यूम करता है अप्रोक्सीमेटली, और या लिख सकते हैं इग्नोरिंग कॉन्वेक्सिटी। So that is the purpose of modified duration. You can estimate the percentage change in the price of the bond. So percentage change in the price of the bond निकालना हो तो माइनस मॉडिफाइड ड्यूरेशन इंटू चेंज इन यील्ड। माइनस साइन क्या इंडिकेट कर रहा है कि अगर बॉन्ड की अगर YTM बढ़ेगा तो प्राइस घटेगी और प्राइस YTM घटेगा तो प्राइस बढ़ेगा। ड्यूरेशन ऑफ एन इरिडीमेबल बॉन्ड। इरिडीमेबल बॉन्ड मतलब इसकी नंबर ऑफ ईयर्स अब इनफाइनाइट हो गई है, तो ड्यूरेशन ऑफ इरिडीमेबल बॉन्ड का फॉर्मूला फिर क्या हो जाता है? 1 प्लस YTM अपॉन YTM, 1 प्लस YTM अपॉन YTM। अगला टास्क इस चैप्टर में है टू आइडेंटिफाई ओवर प्राइस्ड एंड अंडर प्राइस्ड बॉन्ड। ओके, तो हाउ टू आइडेंटिफाई ओवर प्राइस्ड और अंडर प्राइस्ड बॉन्ड? इफ द करंट मार्केट प्राइस of the bond is more than the present value or intrinsic value, more than present value or the intrinsic value, then market price is overvalued, decision sell. If current market price is less than present value, then market price is undervalued, buy. If current market price is equal to present value, then market price is correctly valued, you should hold. Okay. नेक्स्ट है इंटरेस्ट इम्यूनाइजेशन। इंटरेस्ट इम्यूनाइजेशन मीन्स अ स्ट्रैटेजी टू प्रोटेक्ट यू फ्रॉम द चेंजिंग इंटरेस्ट रेट रिस्क। जैसा कि आपने पढ़ा है कि अगर इंटरेस्ट रेट चेंज होता है तो इसके दो अपोजिट इफेक्ट होते हैं। अगर इंटरेस्ट रेट बढ़ता है तो री इन्वेस्टमेंट इनकम बढ़ेगा लेकिन बॉन्ड की वैल्यू घटेगी। अगर इंटरेस्ट रेट घटता है तो बॉन्ड की वैल्यू बढ़ेगी लेकिन री इन्वेस्टमेंट इनकम घटता है। तो अगर आपने कुछ इन्वेस्टमेंट कर रखे हैं किसी फ्यूचर पीरियड के लिए और बाद में मार्केट रेट बढ़ गया तो आपको नुकसान हो सकता है। तो इंटरेस्ट इम्यूनाइजेशन इज अ स्ट्रैटेजी टू प्रिवेंट योरसेल्फ फ्रॉम चेंजिंग इंटरेस्ट रेट रिस्क। ओके, तो इसके ऊपर एग्जाम में न्यूमेरिकल क्वेश्चंस भी आए हुए हैं। चेंज इन इंटरेस्ट रेट्स हैव अपोजिट इफेक्ट ऑफ चेंज इन द बॉन्ड वैल्यू एंड री इन्वेस्टमेंट इनकम। फॉर एग्जाम्पल, इफ इंटरेस्ट रेट इंक्रीजेस इट रिड्यूसेस बॉन्ड वैल्यू but increases the return from reinvestment and vice versa. A portfolio is immunized. अब ये स्ट्रेटेजी आप ध्यान में रखना एग्जाम में क्वेश्चन सॉल्व करने के लिए। when its duration equals the time horizon. अगर आपकी लाइबिलिटी 5 साल बाद की है तो आपके बॉन्ड पोर्टफोलियो का वेटेड एवरेज ड्यूरेशन 5 ईयर होना चाहिए। अगर आपकी लाइबिलिटी मान लो 1 से ज़्यादा दी गई है तो पहले उसका वेटेड एवरेज निकाल लो, उसका ड्यूरेशन निकाल लो और फिर आपके ड्यूरेशन ऑफ पोर्टफोलियो ऑफ बॉन्ड को ड्यूरेशन ऑफ लाइबिलिटी के साथ मैच करवानी है। उसके लिए कई बार आपको इक्वेशन सॉल्व करना पड़ेगा। यहाँ पर हमने लिख दिया है स्टेप नंबर 1। अगर 1 से ज़्यादा लाइबिलिटी हो तो ड्यूरेशन ऑफ लाइबिलिटीज निकाल लेना। ड्यूरेशन ऑफ लाइबिलिटी शुड बी इक्वल टू ड्यूरेशन ऑफ एसेट। कैलकुलेट द ड्यूरेशन ऑफ ईच बॉन्ड गिवन टू अस इन द क्वेश्चन। नॉर्मली क्वेश्चन में कई बार जीरो कूपन बॉन्ड दिया जाता है तो उस समय कैलकुलेशन नहीं करना पड़ता है, लेकिन अगर कूपन बॉन्ड या कोई और बॉन्ड दिया जाएगा तो पहले उनकी ड्यूरेशन निकाल लेना। उसके बाद कैलकुलेट द प्रोपोर्शन ऑफ फंड्स टू बी इन्वेस्टेड इन ईच बॉन्ड बाय सॉल्विंग द इक्वेशन। नॉर्मली हमारे एग्जाम में 2 या 3 बॉन्ड का ही पोर्टफोलियो दिया जाता है। अगर 2 बॉन्ड का पोर्टफोलियो दिया जाए तो एक का वेट आप ए अज्यूम करना उसको मल्टीप्लाई करना, ड्यूरेशन ऑफ बॉन्ड ए, दूसरे का वेट 1 माइनस डब्ल्यू ए एज्यूम करना, तो आपको फिर सिर्फ डब्ल्यू ए निकालने की मेहनत करनी होगी इनटू ड्यूरेशन ऑफ बॉन्ड बी, एंड दिस इज इक्वल टू ड्यूरेशन ऑफ एसेट, एंड दिस शुड बी इक्वल टू ड्यूरेशन ऑफ लाइबिलिटी ऑल्सो। इस इक्वेशन को सॉल्व करके डब्ल्यू ए पहले आ जाएगा, दैट इज वेट ऑफ द फर्स्ट बॉन्ड, 1 माइनस डब्ल्यू ए करेंगे तो वेट ऑफ द सेकेंड बॉन्ड। अगर तीन बॉन्ड का क्वेश्चन हो तो नॉर्मली इन केस ऑफ 3 बॉन्ड्स क्या होता है, एक 2018 के एग्जाम में आया था 3 बॉन्ड, द वेट ऑफ द थर्ड बॉन्ड विल बी गिवन टू यू, वेट ऑफ थर्ड बॉन्ड will be given to you। तो उस केस में एक तो डब्ल्यू ए अज्यूम कर लेना है, दूसरे वाले को बैलेंसिंग फिगर अज्यूम करना, और तीसरे का वेट तो आपको दिया हुआ ही है, और फिर एक इक्वेशन लगा के सॉल्व कर लेना। एक बार आपने वेट्स निकाल लिया तो आप तीनों बॉन्ड्स का अमाउंट टू बी इन्वेस्टेड निकाल सकते हैं। ये यहाँ तक क्वेश्चन यूजुअली आता है कि कितना फंड्स इन्वेस्ट करना है, और एक बार वेट आ गया तो जो लायबिलिटी की प्रेजेंट वैल्यू है उसके साथ वेट को मल्टीप्लाई कर देना है, मल्टीप्लाई प्रेजेंट वैल्यू ऑफ लायबिलिटी इनटू वेट टू गेट द फंड्स टू बी इन्वेस्टेड इन ईच बॉन्ड। ओके, नेक्स्ट इज ऑप्शन एम्बेडेड बॉन्ड। बॉन्ड्स कुछ इस प्रकार के भी होते हैं जिसमें कुछ ऑप्शन पहले से ही एम्बेडेड, उसमें ऑप्शन ऐड किया हुआ है। सिंपल एग्जांपल है कन्वर्टेबल बॉन्ड, जिसमें एक ऑप्शन टू कन्वर्ट द बॉन्ड इनटू शेयर होता है। कॉलेबल बॉन्ड जिसमें ऑप्शन टू कॉल बैक द बॉन्ड होता है। पुटेबल बॉन्ड जिसमें ऑप्शन टू रिडीम द बॉन्ड बिफोर मैच्योरिटी होता है। एक्सटेंडेबल बॉन्ड वेयर द कंपनी इज हैविंग एन ऑप्शन टू एक्सटेंड द मैच्योरिटी ऑफ द बॉन्ड। अब एग्जाम में जो मैंने देखा मैक्सिमम क्वेश्चन यहाँ से आते हैं कन्वर्टिबल बॉन्ड से और कॉलेबल बॉन्ड से। कन्वर्टिबल बॉन्ड से यूजुअली वो अभी एक ही टाइप का क्वेश्चन ज़्यादा पूछ रहे हैं, वो आपको कुछ टर्म्स देंगे, आपको उसकी वैल्यू निकालनी होगी। ठीक है, तो हम सारे टर्म्स एक बार वापस देख लेते हैं रिवीजन के लिए। आपको याद होना चाहिए इनको कैसे कैलकुलेट करते हैं। फर्स्ट, मीनिंग ऑफ कन्वर्टिबल बॉन्ड, बॉन्ड विच कैन बी कन्वर्टेड इनटू अ स्पेसिफाइड नंबर ऑफ शेयर्स एट अ स्पेसिफाइड पीरियड ऑफ टाइम। चलिए अब टर्म्स ध्यान से सुनना और इनको आपको समझना है और एग्जाम में उसको यूज करना आना चाहिए। कन्वर्जन रेशियो, तो कन्वर्जन रेशियो मीन्स नंबर ऑफ शेयर्स दैट ईच बॉन्ड कैन बी कन्वर्टेड टू। कन्वर्जन प्राइस मीन्स द पार वैल्यू ऑफ द बॉन्ड डिवाइडेड बाय कन्वर्जन रेशियो। पार वैल्यू ऑफ द बॉन्ड डिवाइड बाय कन्वर्जन रेशियो। एक बार मैं लिख देता हूं। ओके, ये सारे फॉर्मूले आपकी फॉर्मूला बुक में लिखे हुए हैं। एक SFM की फॉर्मूला बुक मैंने बनाई है, वहाँ सारे फॉर्मूले बिल्कुल इसी सीक्वेंस में लिखे हुए हैं। सिर्फ जो मैं एक्स्ट्रा लिख रहा हूँ आप वहाँ लिख सकते हैं। कन्वर्जन पैरिटी प्राइस का मतलब होता है it is obtained by dividing the current market price of the convertible debenture by conversion ratio। तो इसका फॉर्मूला होगा current price of bond upon conversion ratio। तो ये हो गया conversion parity price। एक होता है straight bond value। स्ट्रेट बॉन्ड वैल्यू का मतलब इट इज द प्राइस ऑफ एन इक्विवेलेंट नॉन कन्वर्टिबल बॉन्ड। अगर इस बॉन्ड में कन्वर्जन फीचर नहीं होता तो इसकी प्राइस क्या होती, तो इसको हम अपने नॉर्मल तरीके से कैलकुलेट करेंगे। कैसे कैलकुलेट करेंगे, जैसे पीवी ऑफ कूपन्स प्लस पीवी ऑफ रिडम्पशन वैल्यू using the discount rate of a equivalent non-convertible bond। using the discount rate of an equivalent non-convertible bond। अब आते हैं डाउनसाइड रिस्क पे। अगर हमने कन्वर्टिबल बॉन्ड परचेस किया तो उसकी वैल्यू घट सकती है। हो सकता है कि शेयर प्राइस बहुत कम हो जाए और वो अट्रैक्टिव ना रहे, तो फिर कन्वर्जन ऑप्शन कोई एक्सरसाइज नहीं करेगा, लेकिन फिर भी कम से कम आपको कैश फ्लो तो मिलेगा। तो बॉन्ड की प्राइस घट के किसके बराबर हो जाएगी? स्ट्रेट बॉन्ड वैल्यू के बराबर हो जाएगी, एंड दैट इज कॉल्ड डाउनसाइड रिस्क। ओके, कई बार एग्जाम में डाउनसाइड रिस्क कैलकुलेट करने के लिए आता है। तो डाउनसाइड रिस्क के लिए आप फॉर्मूला क्या यूज करेंगे? अगर आपको याद हो तो डाउनसाइड रिस्क का फॉर्मूला क्या है? बॉन्ड प्राइस, करंट बॉन्ड प्राइस माइनस स्ट्रेट बॉन्ड वैल्यू। नुकसान होगा तो इतना होगा कि एक बॉन्ड प्राइस घटते घटते कितनी घट जाएगी? कम से कम जो फ्यूचर में कैश फ्लो मिल रहा है उसका प्रेजेंट वैल्यू तो मिलेगा ही, उससे ज़्यादा और क्या गिर सकता है? सो दैट इज कॉल्ड डाउनसाइड रिस्क। इससे आपको पता चलता है कि आप कितना रिस्क ले रहे हो, कितना परसेंटेज का लॉस हो सकता है। नेक्स्ट है स्टॉक वैल्यू ऑफ द बॉन्ड। स्टॉक वैल्यू ऑफ द बॉन्ड इज इक्वल टू करंट मार्केट प्राइस ऑफ द शेयर इनटू कन्वर्जन रेशियो। यानी जो आज शेयर की प्राइस चल रही है और जो कन्वर्जन रेशियो है उनका प्रोडक्ट लेना है। दैट इज द वैल्यू ऑफ द बॉन्ड इन टर्म्स ऑफ द करंट मार्केट वैल्यू ऑफ द शेयर, एंड इट इज ऑल्सो कॉल्ड कन्वर्जन वैल्यू ऑफ द बॉन्ड। तो मैंने ये भी देखा कई एग्जाम में क्वेश्चन आया, कंप्यूट द कन्वर्जन वैल्यू, मतलब नंबर ऑफ शेयर्स इनटू मार्केट प्राइस ऑफ द शेयर मल्टीप्लाई करना है। फिर आता है कन्वर्जन प्रीमियम, कितना प्रीमियम दे रहे हैं आप कंपेयर टू कन्वर्जन वैल्यू। ओके, तो अगर ये क्वेश्चन आए कि कंप्यूट कन्वर्जन वैल्यू, तो फॉर्मूला वहां पे क्या होगा? बॉन्ड प्राइस यानी करंट बॉन्ड प्राइस माइनस कन्वर्जन वैल्यू, माइनस कन्वर्जन वैल्यू अभी आपको मैंने बताया, डिवाइड बाय कन्वर्जन वैल्यू। कन्वर्जन वैल्यू के कंपेयर्ड में कितना एक्स्ट्रा अमाउंट आपने दिया है इन परसेंटेज टर्म्स। फिर होता है एक फ्लोर वैल्यू, मिनिमम बॉन्ड की वैल्यू कितनी होनी चाहिए? हायर ऑफ द टू, स्ट्रेट बॉन्ड वैल्यू और कन्वर्जन वैल्यू। फिर आता है इंट्रिंसिक वैल्यू ऑफ द बॉन्ड। तो एक कन्वर्टिबल बॉन्ड की इंट्रिंसिक वैल्यू कितनी होनी चाहिए? फ्लोर वैल्यू तो होनी चाहिए प्लस ऑप्शन वैल्यू, क्योंकि जब आपके पास कन्वर्टिबल बॉन्ड है तो आपके पास एक ऑप्शन है टू एक्सरसाइज इट और नॉट। सो उस ऑप्शन की भी एक वैल्यू हो सकती है। सो इंट्रिंसिक वैल्यू ऑफ अ कन्वर्टिबल बॉन्ड विल बी फ्लोर वैल्यू प्लस ऑप्शन वैल्यू। अगला है प्रीमियम ओवर स्ट्रेट बॉन्ड वैल्यू। तो जब भी आपको प्रीमियम पूछे, आपको देखना है किसके साथ कंपेयर कर रहे हैं। इस केस में स्ट्रेट बॉन्ड वैल्यू के साथ कंपेयर कर रहे हैं, तो बॉन्ड प्राइस माइनस स्ट्रेट बॉन्ड वैल्यू डिवाइड बाय स्ट्रेट बॉन्ड वैल्यू इनटू 100। नेक्स्ट है एनुअल कैश फ्लो डिफरेंशियल। अगर हम कन्वर्टिबल बॉन्ड खरीदते हैं तो हमें एनुअली कितना इंक्रीमेंटल कैश फ्लो होता है? तो कूपन इनकम फ्रॉम द बॉन्ड माइनस डिविडेंड इनकम फ्रॉम द अंडरलाइंग शेयर। अगर हम शेयर खरीदते तो डिविडेंड मिलता, बॉन्ड खरीद रहे हैं तो कूपन मिलेगा, दोनों का डिफरेंस को हम बोलेंगे एनुअल कैश फ्लो डिफरेंशियल। नेक्स्ट इज पे बैक पीरियड और ब्रेक इवन पीरियड। इट मीन्स हाउ मेनी ईयर्स विल इट टेक फॉर एनुअल कैश फ्लो डिफरेंशियल टू गिव अस बैक द इनिशियल कन्वर्जन प्रीमियम। तो हमने जो कन्वर्जन प्रीमियम दिया था उसको रिकवर करने में कितने साल लगेंगे, और उसका फॉर्मूला है बॉन्ड प्राइस माइनस कन्वर्जन वैल्यू। ये हो गया कन्वर्जन प्रीमियम इन रुपीज डिवाइड बाय एनुअल कैश फ्लो डिफरेंशियल। तो व्हाट इज द टाइम पीरियड रिक्वायर्ड टू रिकवर योर कन्वर्जन प्रीमियम? नेक्स्ट फॉर्मूला है कन्वर्जन प्रीमियम पर शेयर। कन्वर्जन प्रीमियम पर शेयर पूछ रहा है, एक शेयर के बदले कितना आपने प्रीमियम दिया है। तो बॉन्ड प्राइस माइनस कन्वर्जन वैल्यू अपॉन कन्वर्जन रेशियो विल गिव यू कन्वर्जन प्रीमियम पर शेयर। यहाँ पे इंटू 100 की जरूरत नहीं है, राइट। अगला आता है कॉलेबल बॉन्ड। कॉलेबल बॉन्ड में जो मैंने देखा अब तक मोस्टली एक ही टाइप का क्वेश्चन आ रहा है, वेदर द ओल्ड बॉन्ड शुड बी रिफंडेड और नॉट। तो ओल्ड बॉन्ड को रिफंड करना है या नहीं करना है, ये एक तरह से बेनिफिट कॉस्ट एनालिसिस है, जिसको हम बोलेंगे, जैसे हम कैपिटल बजटिंग में एनपीवी एनालिसिस करते थे, पीवी ऑफ इनफ्लो माइनस पीवी ऑफ आउटफ्लो। अगर एनपीवी पॉजिटिव है तो हम बॉन्ड को रिफंड करेंगे। इसके लिए हम क्या ट्रिक यूज करते हैं, या इसको मैंने कैसे सिंप्लीफाई किया वो समझिए। हम पहले ईयर 0 की कैश फ्लोज निकाल लेंगे। तो ईयर जीरो में जो कैश फ्लोज होगा वो क्या क्या हो सकता है जरा समझो, रिवाइज करो। आज रिवीजन का दिन है। पहले हम जो बॉन्ड रिडीम करेंगे उस पर यूजुअली प्रीमियम देते हैं, तो कॉल प्रीमियम ऑन ओल्ड बॉन्ड, लेकिन उस पर मिलेगा आपको टैक्स शील्ड क्योंकि प्रीमियम आपकी बुक में एक्सपेंस माना जाएगा। सो कॉल प्रीमियम माइनस टैक्स शील्ड इज कॉल्ड आफ्टर टैक्स कॉस्ट ऑफ कॉल प्रीमियम। इसको ईयर जीरो में आउटफ्लो दिखाएंगे। नया बॉन्ड इशू करेंगे, फ्लोटेशन कॉस्ट लगेगा, उसको भी हम आउटफ्लो दिखाएंगे। कई बार ओल्ड बॉन्ड और न्यू बॉन्ड दोनों पैरेलली कुछ महीने 2 महीने साथ साथ चलते हैं। उस केस में ओल्ड बॉन्ड पे भी इंटरेस्ट जो हम भरते हैं उसको हम बोलते हैं ओवरलैपिंग इंटरेस्ट। न्यू बॉन्ड का भी इंटरेस्ट का मीटर चालू हो गया, ओल्ड बॉन्ड का इंटरेस्ट का मीटर भी चल रहा है क्योंकि उसको अभी रिडीम करने में हो सकता है कुछ महीने लग जाएं। तो जब तक वो ओल्ड बॉन्ड रिडीम नहीं होता उस पर भी जो इंटरेस्ट पे करेंगे उसको भी हम यहाँ कंसिडर करेंगे नेट ऑफ टैक्स। पिछले बॉन्ड को अगर आपने डिस्काउंट पे इशू किया था पुराने बॉन्ड को, तो उसका जो अनअमोर्टाइज्ड डिस्काउंट है उसको आज आप राइट ऑफ करना, उस पर टैक्स शील्ड मिलेगा इनफ्लो। पुराने बॉन्ड को अगर आपने फ्लोटेशन कॉस्ट पे इनकर किया था, तो उसका जो अनअमोर्टाइज्ड फ्लोटेशन कॉस्ट वाला पोर्शन है जो अभी भी हमारी बुक्स में है उसको राइट ऑफ करेंगे, उस पर टैक्स शील्ड मिलेगा इनफ्लो। और अगर न्यू बॉन्ड को आपने डिस्काउंट पे इशू किया है तो डिस्काउंट ऑन न्यू बॉन्ड विल बी शोन एज आउटफ्लो। ये हो गया हमारा फर्स्ट वर्किंग नोट। सेकेंड वर्किंग नोट में हमें क्या करना है, कैश फ्लो ओवर रिमेनिंग मैच्योरिटी निकालनी है। तो हमें देखना है कि हमारे डिसीजन से फ्यूचर में कैश फ्लोज में क्या क्या चेंजेस आएंगे। एक तो जो सबसे बड़ा चेंज है वो है आपका इंटरेस्ट सेव होगा, इंटरेस्ट सेव्ड नेट ऑफ टैक्स लेंगे इनफ्लो। दूसरा, जो नया बॉन्ड आपने इशू किया था उस पर फ्लोटेशन कॉस्ट आपने इनकर किया था, उसका आपको टैक्स सेविंग होगा ओवर द लाइफ ऑफ द बॉन्ड इनफ्लो। लेकिन पुराने बॉन्ड को आपने रिडीम कर दिया है तो उसका जो फ्लोटेशन कॉस्ट का टैक्स शील्ड मिल रहा था वो अब नहीं मिलेगा, तो माइनस करेंगे आउटफ्लो। अगर आपने नए बॉन्ड को डिस्काउंट पे इशू किया है तो डिस्काउंट को हम अमोर्टाइज करेंगे ओवर द लाइफ ऑफ द बॉन्ड, उसकी टैक्स शील्ड मिलेगी इनफ्लो। और चूंकि पुराने बॉन्ड को आपने रिफंड कर दिया है तो उस पे जो टैक्स शील्ड मिल रहा था अब वो मिलना बंद हो जाएगा, तो दैट इज माई लॉस एंड इट इज कॉल्ड आउटफ्लो। इसका हम टोटल कर लेंगे। ये हो गया हमारा कैश फ्लो ओवर रिमेनिंग मैच्योरिटी। एक टोटल करने के बाद हमें एक एनवीटी मिलेगी। टोटल करने के बाद यहां पर आपको एक एनवीटी मिलेगी, इसका प्रेजेंट वैल्यू निकाल लेना बाय मल्टीप्लाइंग बाय पीवी एनवीटी फैक्टर। तो ये हमको देगा पीवी ऑफ सेविंग्स, और इसको मैं कंपेयर करूंगा ईयर जीरो के इनिशियल आउटफ्लो से। इफ पीवी ऑफ सेविंग इज मोर देन इनिशियल आउटफ्लो, वेलकम, रिफंड द बॉन्ड। ओके। और अगर मान लो पीवी ऑफ सेविंग कम है और आउटफ्लो ज्यादा है, इट इज बेटर टू कंटिन्यू विद द ओल्ड बॉन्ड ओनली। नेक्स्ट हमारा कॉन्सेप्ट है यील्ड कर्व और टर्म स्ट्रक्चर। व्हाट इज यील्ड कर्व? Yield curve is a graphical presentation which shows the yield and maturities of similar quality bond. It shows yield and maturity of similar quality bond. तो ये हो गया maturity, ये हो गया yield। तो yield curve देखकर आपको समझ में आता है कि whether long term bonds have higher rate of interest or short term bond, whether interest rates are going to increase or not in future, and if you know the maturity of a bond you can estimate the yield of that bond. Okay, so yield curve exhibits the YTM of bond similar in all respects except the term. The study of yield curve tells us the relationship of the term and the YTM. With the help of yield curve, investor can easily find out the yield that are available on comparable fixed income security for short term, medium term and long term. तो थियरी क्वेश्चन के लिए इंपॉर्टेंट है व्हाट इज यील्ड कर्व। अगला थियरी क्वेश्चन के लिए इंपॉर्टेंट है व्हाट आर द टाइप्स ऑफ यील्ड कर्व, और राइट अ नोट ऑन अपवर्ड स्लोपिंग और नॉर्मल यील्ड कर्व। अपवर्ड स्लोपिंग और नॉर्मल यील्ड कर्व मतलब शॉर्ट टर्म इंटरेस्ट रेट्स आर एक्सपेक्टेड टू राइज इन फ्यूचर, शॉर्ट टर्म रेट्स आर लोअर देन लॉन्ग टर्म रेट। अभी जो मैंने एक डायग्राम ड्रॉ किया था, ऐसा डायग्राम अगर आता है तो इसको बोलते हैं अपवर्ड स्लोपिंग यील्ड कर्व। नॉर्मली मार्केट में, नॉर्मली इसलिए इसका नाम नॉर्मल यील्ड कर्व भी है। अगर मैच्योरिटी कम होगी तो उसका यील्ड भी कम होगा, और मैच्योरिटी ज़्यादा होगी तो उसका यील्ड भी ज़्यादा होगा। बिकॉज लॉन्ग टर्म मैच्योरिटी वाले बॉन्ड का रिस्क ज़्यादा होता है, इसलिए इन्वेस्टर उस पर हाइयर यील्ड चाहता है। इसका अपोजिट होगा डाउनवर्ड स्लोपिंग यील्ड कर्व। इसको और क्या कहते हैं, किसी और नाम से इन्वर्टेड यील्ड कर्व। इसका मतलब है शॉर्ट टर्म रेट्स आर एक्सपेक्टेड टू फॉल इन फ्यूचर एंड शॉर्ट टर्म रेट्स आर हाइयर देन लॉन्ग टर्म रेट्स। तो इसको अगर एग्जाम में ये क्वेश्चन आए तो डायग्राम कुछ इस तरह से बनाना है। सच यील्ड कर्व्स आर रेयर, मतलब यूजुअली इस टाइप के यील्ड कर्व देखने को मिलेगा, इसकी पॉसिबिलिटी कम है। और तीसरा होता है फ्लैट यील्ड कर्व। यहाँ पे क्या होगा, शॉर्ट टर्म रेट्स आर एक्सपेक्टेड टू रिमेन अनचेंज इन फ्यूचर। तो इस बार ये जो यील्ड कर्व होगा वो ऑलमोस्ट स्ट्रेट होगा। इसका मतलब है कि इरेस्पेक्टिव ऑफ मैच्योरिटी द यील्ड इज द सेम। ओके, देन व्हाट इज द रिलेशनशिप बिटवीन स्पॉट रेट एंड फॉरवर्ड रेट? Spot rate means the rate of interest at which you can borrow or lend a sum of money today. And forward rate of interest means the rate of interest which is fixed today for borrowing or investment to take place at a future date. And there is a mathematical connection between the spot rate and forward rate, otherwise arbitrage opportunity will arise. How to read the notations? फॉरवर्ड रेट को हम नोटेशंस कैसे पढ़ेंगे? फॉरवर्ड रेट F12 का मतलब होता है 1 ईयर फॉरवर्ड रेट आफ्टर 1 ईयर, और 1 ईयर फॉरवर्ड रेट एट t इक्वल टू 0, और 1 ईयर फॉरवर्ड रेट फॉर द सेकेंड ईयर। ओके, जिसको हम सिंपल कहेंगे F12 का मतलब है कि अगर हम आज से 1 साल के बाद बोरो करेंगे, 1 साल के लिए बोरिंग करेंगे, यहाँ पे ये बिगिनिंग ऑफ द बोरिंग पीरियड है, ये एंड ऑफ द बोरिंग पीरियड है। तो आज से अगर मैं 1 साल के बाद 1 साल के लिए बोरो करूं तो रेट क्या होगा, उसको बोलते हैं फॉरवर्ड रेट, और उसको नोटेशन है F12। उसी तरह अगर F34 दिया हुआ है क्वेश्चन में तो इसका मतलब 1 ईयर फॉरवर्ड रेट आफ्टर 3 ईयर, और 1 ईयर फॉरवर्ड रेट एट टाइम इक्वल टू 3 ईयर, और 1 ईयर फॉरवर्ड रेट फॉर द 4th ईयर। F35 दिया तो इसका मतलब क्या है, 2 ईयर फॉरवर्ड रेट आफ्टर 3 ईयर, और 2 ईयर फॉरवर्ड रेट एट t इक्वल टू 3। और सिंपल लैंग्वेज में समझने के लिए, अगर मैं आज से 3 साल के बाद बोरो या लेड करूं 2 साल के लिए, बोरो करूंगा 3 साल बाद और बोरो करूंगा 2 साल के लिए, तो रेट ऑफ इंटरेस्ट क्या होगा, दैट इज कॉल्ड फॉरवर्ड रेट 3,5। ओके, फॉरवर्ड रेट निकालेंगे कैसे? तो फॉरवर्ड रेट निकालने के पहले आपको स्पॉट रेट्स निकाल लेना है। ओके, अगर गैप 1 साल का है, यानी इस टाइप का क्वेश्चन आए F12, F34, क्योंकि आप देख रहे हैं 1-1 साल का गैप है, तो फॉर्मूला होगा 1 प्लस Rn टू दी पावर n अपॉन 1 प्लस Rn माइनस 1 टू दी पावर n माइनस 1 माइनस 1। ओके, जैसे फॉर एग्जाम्पल F12 निकालना हो तो 1 प्लस Ra2 टू दी पावर 2 अपॉन 1 प्लस Ra1 टू दी पावर 1 टू दी पावर 1/1 माइनस 1। लेकिन अगर गैप 1 साल से ज्यादा हो तो फिर थोड़ा ध्यान रखना, 1 प्लस Ra, यहाँ पे 3 होना चाहिए, 1 प्लस Ra3 टू दी पावर 3 अपॉन 1 प्लस Ra टू दी पावर 1। अब यहाँ पे इनके बीच 2 साल का गैप है तो हम 1/2 लेंगे, पावर 1/2। अगर ये गैप 3 साल का होगा तो 1/3, गैप 4 साल का होगा तो 1/4 माइनस 1, तो आपको फॉरवर्ड रेट आ जाएगा। ठीक है, अब टर्म स्ट्रक्चर में कुछ थियरीज भी हम देख लेते हैं। एक होता है लिक्विडिटी प्रेफरेंस थियरी, जो आप लोगों ने इकोनॉमिक्स में भी शायद पढ़ा होगा, इकोनॉमिक्स के क्लासेस में, बीकॉम में। लिक्विडिटी प्रेफरेंस थियरी, जो इन्वेस्टर्स होते हैं वो चाहते हैं कि लिक्विडिटी हमारे पास रहे, लेकिन अगर कोई और उससे ले रहा है तो बदले में उसको कॉम्पनसेशन चाहिए। तो तो जितना उसकी लिक्विडिटी प्रेफरेंस स्ट्रांग रहेगी, उससे पैसा लेने के लिए आपको उसको उतना ज़्यादा कॉम्पनसेशन देना पड़ेगा। तो दैट इज लिक्विडिटी प्रेफरेंस थियरी। थियरी क्वेश्चन के लिए आप इसको टिक कर सकते हैं। एज पर दिस थियरी, फॉरवर्ड रेट्स रिफ्लेक्ट्स इन्वेस्टर्स एक्सपेक्टेशन ऑफ फ्यूचर स्पॉट रेट प्लस अ लिक्विडिटी प्रीमियम to compensate them for exposure to interest rate risk. Positive slope may be a result of liquidity premium. तो जितना लिक्विडिटी प्रेफरेंस स्ट्रांग होगी, उसको उतना लिक्विडिटी प्रीमियम देना पड़ेगा ताकि वो पैसे निकाल कर आपको देख सके। देन नेक्स्ट इज प्रेफर्ड हैबिटेड थियरी। इसको भी टिक कर लेना। प्रेफर्ड हैबिटेड थियरी मतलब कि why the interest rates are high or low in a certain period. It depends on demand and supply of money. Premiums are related to supply and demand for funds at various maturities, not the term to maturity, and hence this theory can be used to explain almost any yield curve shape. तो कभी अगर आप देखेंगे कि अपवर्ड स्लोपिंग यील्ड कर्व है, अपवर्ड स्लोपिंग यील्ड कर्व का मतलब है कि शॉर्ट टर्म में सप्लाई ज़्यादा है, डिमांड कम है, और लॉन्ग टर्म में डिमांड ज़्यादा है, सप्लाई कम है, इसलिए अपवर्ड स्लोपिंग यील्ड कर्व। और अगर डाउनवर्ड स्लोपिंग यील्ड कर्व है, मतलब शॉर्ट टर्म में डिमांड ज़्यादा है मनी की, सप्लाई कम है, एंड लॉन्ग टर्म में सप्लाई ज़्यादा है, डिमांड कम है, तो ये इसको हम बोलते हैं प्रेफर्ड हैबिटेड थियरी। एक लास्ट चीज़ और थियरी क्वेश्चन के लिए डिस्कस कर सकता हूँ, जो एग्जाम में कई बार पूछे गए हैं पहले पास्ट में, कि व्हाट आर द वेरियस टाइप्स ऑफ रिस्क एसोसिएटेड विथ इन्वेस्टमेंट इन बॉन्ड। यूजुअली लोग सोचते हैं कि बॉन्ड में इन्वेस्ट करेंगे तो कोई रिस्क नहीं, लेकिन यहाँ पर भी कुछ रिस्क होते हैं, उनकी एक लिस्ट बना रहा हूँ। डिटेल डिस्कशन आपकी नॉर्मल बैच में होता है। क्रेडिट रिस्क यानी डिफॉल्ट रिस्क, सामने वाली कंपनी पैसा नहीं देगी। मार्केट रिस्क यानी मार्केट का इंटरेस्ट रेट ऊपर नीचे हो सकता है, जिससे आपकी बॉन्ड की वैल्यू चेंज हो सकती है। और इंटरेस्ट रेट रिस्क यानी इंटरेस्ट रेट बढ़ सकता है या घट सकता है, उससे आपकी री इन्वेस्टमेंट इनकम बढ़ सकती है, घट सकती है, वैल्यू ऑफ बॉन्ड बढ़ सकती है, घट सकती है। सारे रिस्क आप देखेंगे काफ़ी रिलेटेड भी हैं। री इन्वेस्टमेंट रिस्क का मतलब है कि आपने बॉन्ड में इन्वेस्ट किया, उसके बाद मार्केट रेट ऑफ इंटरेस्ट घट गया, तो जो री इन्वेस्टमेंट इनकम होगी वो घट जाएगी। कॉल रिस्क इज एसोसिएटेड विथ कॉलेबल बॉन्ड। अगर मार्केट में इंटरेस्ट रेट बहुत कम हो गया तो कंपनी बॉन्ड को कॉल बैक कर सकती है और आपको नुकसान हो सकता है। इन्फ्लेशन रिस्क मीन्स परचेजिंग पावर रिस्क। अगर बॉन्ड पे एक फिक्स्ड इनकम मिल रहा है और मार्केट में इन्फ्लेशन उस फिक्स रेट ऑफ इंटरेस्ट से भी ज़्यादा है, तो एक्चुअली आप कुछ अर्न नहीं कर रहे हैं, यू आर लूजिंग द परचेजिंग पावर ऑफ योर मनी, दैट इज कॉल्ड इन्फ्लेशन रिस्क। तो ये था। एक और पढ़ लेते हैं। लिक्विडिटी रिस्क मतलब बॉन्ड को आप कैश में कन्वर्ट नहीं कर सकते हैं। कई बार सिचुएशन ऐसी हो सकती है कि आप बॉन्ड बेचने जा रहे हो लेकिन खरीदार नहीं है। जैसे अभी आपने न्यूज़पेपर में पढ़ा कि फ्रैंकलिन टेम्पल्टन ने 6 डेट फंड्स को बंद करने का निर्णय लिया। उनसे पूछा गया कि आप ऐसा क्यों कर रहे हैं, उनको कहा कि बहुत ज़्यादा लिक्विडिटी प्रॉब्लम हो गई है कि हम इसको सेल करने जा रहे हैं लेकिन कोई खरीदार नहीं है। तो दैट इज़ कॉल्ड लिक्विडिटी रिस्क। जैसे आप ये इनकम टैक्स में भी एग्जाम्पशन लेने के लिए कुछ बॉन्ड में इन्वेस्ट करते हैं, वहाँ पे भी 5-6 साल का लॉक इन हो जाता है, दैट इज़ कॉल्ड लिक्विडिटी रिस्क। So thank you very much for watching this video, and this was a small summary on bond valuation. Thank you.